Look, there's trillions of dollars of loans, LIBOR, etc. Let's lower that rate, make sure there's no financing problems there. I'm not going to say that's going to solve the crisis or is a cure-all, but I don't think it makes sense right now. Cash is yielding 1.6. We hear that the 10-year is at what, 115. That doesn't make sense to me. I think the Fed should act again. Just let's make some room there for easing on the financial side.
Well,
I
Kevin
see this
Warsh,
as a very severe one-year shock, and then a bounce back that could be extremely rigorous.
Jeremy, Kevin Warsh, former Fed governor, was on Squawk Box this morning after he published an op-ed calling for the Fed to lower interest rates, calling actually this morning a step further for global coordinated central bank action. Listen to what he said.
Sooner they cut, the better. If I were giving them advice, I would say get to this weekend, take stock, reach out, starting at the close of business today to the world's central bankers, and at the very least on Sunday night before markets open, have a unified statement from the big central bankers in the world that they are all over this. It's a signal to businesses out there that they shouldn't decide to give up on 2020. Markets open, have a unified statement from the big central bankers in the world.
I think it will help. Yes. Will it cure everything? No, but I think he's right. I think we should have a 50 basis point cut, and I would like to see other central banks around the world do the same. It cannot hurt. It cannot hurt.
What if you just said we might have a recession, which obviously may be already being reflected in equity prices right now to some extent. But what happens if we do? And what are we working with? 1.75 in the Fed funds, or something like that, right? So wouldn't we be getting rid of all our ammunition? If we cut 50 basis point now, and then we have a recession come the fall. Say again.
There's always more ammunition.
Then we go back down to zero. That's true. And
then we go into QE, right?
We were 7 years at what, 6 or 7 years at zero in the early stages of the financial crisis, and I mean, in a way that helped prevent it from going. $1930. So yes, that helped. It does not solve the problem completely. It helps. Concerted action, I think, would. The Europeans,
what are the Europeans supposed to do since they're already there? And another thing, Jeremy,
they're already there.
I mean, Greek yields in Greece are going up because people are now worried about their ability to service debt outright.
Correct. So what you got is that the risk, we now get the spread between the sovereigns, the AAAs, the German bonds, the U.S. bonds, Japanese bonds, which are the AAA sovereigns. The rush to safety is going to them, and all other credit risks are expanding. So Greece, even Italy, of course, it has some of the virus, and then you get the single A credits, the B credits. We're going to get a widening. We're not going to get a widening like we had over Lehman Brothers, which was extreme. But we're going to get a widening credits. There's no question about that. This is very predictable, very normal.
So
in this type of a crisis.
Just to sum up your bottom line, Professor Siegel, for people watching and they listen to you, see you on the commercials, are you saying that it depends on your time horizon here of what you should do with stocks? Near term, maybe more pain. Longer term investors, what? Sit with what they have, take the opportunity to buy?
Yes, absolutely. I mean that this could be a really tough year. But 2021, 22 onward, there's no reason not to say we're going to snap back from this. We always had. I mean, you go back to the 1918 virus, terrible 1 year, and then, things got much better economic. You got to look far forward. If you got some cash now, time to put it to work. Don't get nervous if it comes down another 5 or 10%. Well, that 10% from now would be the bear market. It would take care of that recession. but you're going to get a bounce back in 2021 that I think is going to really make a lot of investors glad that they didn't panic and sell out.
We're already 15.5% down from the record high. Professor Jeremy Siegel, thank you for joining us.
Thank you.
Well, another big story, of course, that we've been following is bond yields. We talked a bit about that with the professor. Their lowest level in years this week. We're talking about the 10 and the 30-year, both of which have hit record lows. Let's take a look at that 10-year, 1.16. Hard to imagine. Joining us now to discuss, Charles Schwab's chief fixed income strategist, Kathy Jones. Kathy, let me just start there. I mean, it may make perfect sense, 1.168 to, lend your money to the U.S. government for 10 years. But what does it say, and is it sustainable?
So what it says is that there's a flight to safety, obviously, and that people were mispricing risk. I think there was a lot of complacency in the market. We had very tight credit spreads, very low yields on high yield bonds, very high valuations on stocks, and people were caught when this happened, and they've been rushing into treasuries. It also tells us that the market is expecting the Fed to cut rates, just as everyone's asking them to do. So the market is building in a couple of rate cuts, and that's going to work its way through the entire yield curve. Is it sustainable? For a while, sure. Of course. I mean, I've been asked since 1986 when the bond bull market is going to end, and I keep saying, not anytime soon. I'll probably be retired.
Every year for the last 10 years, I think we've started the year saying this is the year when we're going to finally see rates rise. And we did it again this year, I think, too. And
exactly.
Here we are, 2 months into the year.
Now, will they bounce off of these levels? Sure. I mean, it wouldn't be too surprising if things calm down that we get a bit of a bounce. But the problem is now if we morph from, supply shock to demand decline to recession, and what we have to watch is employment, because that's the mainstay of this economy has been job growth and decent consumer spending. If that starts to roll over in response to that, then we have...
So that brings up an interesting point. Some have said JOLTS suggested we were already getting there, even with the limited data set. Was it just a matter of time before this jobs cycle rolled?
Well, at some point, although we have a very tight labor market, so there wasn't necessarily looking like it in 2020 until this all happened. But yeah, JOLTS, the new job openings have rolled over. We'll have to wait and see jobless claims. If they start to pick up, that would be a sign. But, it wouldn't be surprising after 10 or 11 years that we're going to hit a speed bump that sent us into a recession. So employment's really, for us, that's the key to watch from here.
Do you have a base case as to when we would see the string of monthly increases in employment end?
I don't have a base case yet. I want to see those jobless claims tick up, and then we would start to say, okay, maybe second, third quarter, probably third quarter and beyond, we could see that. The yield curve's telling you it's, recession risk has risen. Credit spreads are telling you recession risk is rising, and that's what we're monitoring right now.
So you mentioned that the market is starting to price in and actually bet on the probability going up of the Federal Reserve cutting interest rates. As the market does that more and more aggressively, we're now talking about a potential 50 basis, a times 2 kind of cut. Isn't the scope for disappointment even more when the Fed does actually act, if they do?
Yeah, I don't think there's going to be a 50 basis point cut, okay, because we haven't had one in, 20 years or something, and that would almost signal panic. I think they're trying to take a very cool, calm approach, saying this is a supply shock, we can only do so much with monetary policy, blah, blah, blah. We've all heard that from them. But I think that they're going to look at some of these indicators and say, if we get financial conditions really tightening, as they are with credit spreads blowing up, then they're going to say, well, we can mitigate that risk by edging rates lower. But I think they'll take a slow approach. I don't think they're going to come in with shock and awe.
You think they wait to the meeting, or can we get an intermeeting cut?
I think they wait for the meeting. I don't think they want to signal that they're panicking. I think they just feel that would probably make it worse.
So let's be clear. Credit spreads are not blowing out.
Well, they've gone from extremely low levels back to slightly above normal.
Right.
But they've done it very fast.
I think what's interesting about it, and David and I were talking about it, is that we didn't see that type of reaction when some of the trade war risks, for instance, were happening. I mean, there was a lot more complacency in this market over other periods of market risk in the last few years.
Yeah, I think who would have predicted this, right? I mean, this is not one of those things that you put into your forecast and say, well, if this happens or if that happens. We knew about the trade war. We knew about some of these other risks. This was a risk that just came out of the blue. And so it wasn't priced in at all.
There's a lot of liquidity in the system, isn't there? I mean, there's not a lack of that at all.
Ample liquidity in the system. But again, if financial conditions start to tighten, we saw this in 2018. Now, there were other things going on. The Fed was raising rates and signaling more rate hikes, so that was a problem. But when you saw financial conditions really tighten in the fourth quarter of 2018, they did pivot and switch to an easier policy, saying if we get to that situation again, a pivot to slightly easier policy is probable. But again, as everyone's been saying, it can only do so much.
Warsh, this morning on our air, suggested that the argument for this cut, which he's made in the op-ed earlier in the week, is stronger than the ones for the last three. Do you agree with that?
No, I don't think so. We're not at that point in terms of credit conditions and also the signaling. They have been signaling easier policy for quite some time. The last three, they had been signaling tighter policy, so they needed to reverse that. This time, they're already on an easing path, so I think this is just an incremental change.
So if I'm in stocks, should I be moving money to bonds, or is it too late?
Well, we always advocate people have a strategic asset allocation that's consistent with their risk capacity and their risk tolerance. And if you find that you're really nervous right now, it means you didn't have the right allocation. So, I talk to a lot of investors who say they don't want to buy bonds because yields are too low. I tell them that's not the only reason you buy bonds. You buy them for times like this because they provide the best diversification from stocks. So if you're uncomfortable with where you are, then you need to probably think about making some changes.
Kathy, thank you.
Thank you.
We're going to, I think, monitor Larry Kudlow, who is about to make comments in the briefing room in a few moments. Are we seeing him yet?
Not yet.
All right. Well,
I think it's important to hear from him. I think it's important to hear from the White House because there is this feeling right now that the communication from the White House, from the Federal Reserve, I'm thinking about Jim Bullard, St. Louis Fed president, comments just in the last hour, that their urgency is not matching what we are seeing in the market. This is our third day of 1,000-point declines potentially in the market. This has been sharp, brutal, and severe. And what we're getting from the White House, President Trump, to his credit, closing the flights from China early, that's the sort of action that I think was applauded by investors. Now saying everything's okay and, I'm going to go to a rally tonight, that's not the sort of action. I'm not trying to make it political, but in these times of market panic, people look for their leaders to have calm and to show that they're on top of it. And we're not really seeing it from the Fed yet or from the White House.
It's definitely a test of confidence. The market craves, some have suggested, daily briefings from CDC, same time, same place, where you can check in and understand where we are in this whole arc. Detection and testing efforts are taking center stage as well as the spread continues around the world. One company in the spotlight is diagnostics company, I hope I get this right, Qiagen, just announcing a plan to submit one of the first commercial test panels for coronavirus to the FDA by Monday, with the company sending test kits to 4 hospitals in China earlier this week. Joining us to discuss is Qiagen's interim CEO, Terry Bernard, and our own Meg Terrell. Meg?
Carl, you were so close. It's Qiagen. And Terry, thank you so much for being here this morning. Plans to submit for FDA emergency use authorization by Monday. Tell us how quickly your test could be available here in the U.S.
Good morning, first of all, and thanks for having me again. We are currently gathering data to be able to submit to the FDA as soon as possible. You know that the FDA has introduced an emergency approval channel. This is where we want to submit our data. So first, what we have to do, because you can imagine, Meg, that we are submitting our solution to many countries all around the world, in Europe, but also in Asia. And therefore, anytime you want to get approved, you need to adjust your solution to local clinical data and patient data. And this is what we are doing currently in the US. We want to bring that package of clinical data as soon as possible to the FDA here. I expect that test to be available in the first 15 days, I would say, of the month of March.
So the first 2 weeks of March, you'd expect the FDA to give you the clearance to, or give hospitals and users the clearance to start using your test?
Obviously, the final answer is in the hands of the FDA, but this is our objective. And we are really ramping up efforts, as we did in Europe, as we did in Asia Pacific, to meet that challenging timeline, obviously, and bring that solution, because it's a key solution, to the US hospital as soon as possible.
Right. I know there are a lot of great things about this potential offering. One is that the results can come back in just about an hour, and also that it's on a panel of other respiratory viruses that you'd be testing for. Is that right? And I also understand it does require some specialized equipment. So how widely available is that equipment right now?
So you are perfectly right, Meg. And what I would like to say first is that anytime you see the apparition of a novel pathogen, the first solution, when you want to understand that novel virus, in this case, always come from a reference lab. And this is exactly what happened here in the US. Like in other countries, the CDC started to develop a test and then developed and provided that test to sites in the US. But now, I mean, we are at a stage, because of the progression of the contamination, that we need to be able to test much more many people and in a faster time to result. And this is exactly what our solution is providing. As you said, the result is coming in less than an hour, and at the same time, the test is extremely easy to use. I mean, it's a simple swab that you put in a cartridge which is as small as this. It's half the size of your iPhone, for example, and you introduce the swab in the cartridge, break the swabs, put the swab into a reader which is the size of your laptop, and so basically you have no real technician interventions. You don't need to have a lot of expertise to process the test, and so fairly easy to use and extremely fast. The test and the system is already available in the US. As you said, Meg, we have basically taken the respiratory cartridge that we cleared with the FDA a bit less than a year ago in the US, and we added 2 genes to detect that specific coronavirus. Those are the 2 genes that are recommended either by the Chinese CDC or by the American CDC. And therefore, the value also of the test is that not only you can detect that novel coronavirus, but also you can differentiate it against different respiratory syndrome, be them flu, for example, RSV, or other coronaviruses.
Terry, we know also that QIAGEN provides the reagents, the chemicals used for tests, lab-developed tests, for example, to be able to run their own diagnostics. Are you seeing the ability to provide those reagents? As we have heard of some issues with the CDC-developed tests, we know that labs and hospitals want to offer their own tests. So what can you say about the ability of hospitals to be able to do that themselves, develop their own tests and use potentially your reagents?
So the strength of QIAGEN is that we are a molecular diagnostic company, and so we provide a wide range of solutions, from extraction of nucleic acids, component of tests that laboratories will be able to use to develop their own tests, to final assays. And indeed, if you look, for example, at the list of recommended solution, what we call the CDC protocols, you will see many of the QIAGEN products. So by delivering components of tests to hospitals in the US, we are already helping them to develop their own, what we call laboratory developed tests internally.
All right, Terry, thank you so much for being here this morning, and we look forward to talking with you again soon as this develops.
Thank you so much for having me. Thank you.
Carl, back over to you.
All right, Meg, our thanks to you, our Meg Terrell, back at headquarters. Dow down 930. Mike Santoli joins us here on set, our senior markets commentator. I noticed Robert Hum, one of our statisticians, says at the low today, Dow wiped out all of last year's gain.
Yes. And as a matter of fact, the S&P is back to the highs of January 2018. So that was that big, steep rally we got after the tax cut was passed. So you're going back in time as well as going down in price. I think that's something to always keep in mind. You're running out of superlatives in terms of talking about how indiscriminate the selling has been, how intense and how concentrated these losses have been. So what it does in part is tell you just exactly how offside, mispositioned, overcommitted investors were in aggregate a month ago. I think a lot of the kind of mechanical, systematic hedge fund type strategies that were a bit over their skis, I think that's cleared through the market. That's what we've been seeing this week largely. But you have retail outflows, that's happening today, and you don't really have nearby rock bottom valuation support. And I think that's something that we're going to have to contend with for a while, even after we get a rally to attempt.
That was Goldman's point this morning. Positioning and valuations not yet depressed enough.
Yes, I think that's fair. And I also think that in terms of the market's ability to absorb and shrug off incremental news about the virus spread, about economic impact, about all these measures, I'm not sure we've been living with it for long enough. So yes, the market has rushed to a place that's pricing in a severe deceleration of activity and some stress on corporate America. But have we gotten to the point where we're saying, oh yeah, we knew that already? And so I don't know how to test that exactly. And I keep going back to the post 9/11 scenario. We were already in a bear market, we were already in a recession, but the shock of it and the expansive speculation about what it was going to mean for long term in terms of travel, consumers, corporate behavior, public confidence, employment, everything. That was a complete fog, right? The market repriced radically lower. You did get some Fed help, and then you kind of found a way. And by the way, after that, all the stray reports of a bomb threat or suspicious activity, the market just didn't care after a while. And I don't know where we are in that process.
Well, we're in the point where it seems like headlines are still very sensitive for the markets.
Yes.
We're down another 1,000 points here on the Dow. The WHO, World Health Organization, is conducting their news conference right now, saying they've increased their assessment of the risk of spread and risk of impact of COVID-19 to a very high global level, stopping short of calling it a pandemic. They update the numbers. They do say, though, that they can trace most cases to contacts or clusters of cases. They don't see evidence as yet that the virus is spreading freely in communities in the past 24 hours. 7 countries have reported cases, though, for the very first time. So it feels like this is still a market that is very focused on these types of headlines and reacting.
It's focused on those headlines. It's focused on, is the response going to be sufficient or reassuring? But I also think it's focused on, when does China come back? What are companies doing on a preventative basis to try and stay out of harm's way, and what does that mean for spending?
Well, that's the point.
Yeah.
I mean, that was J.P. Morgan made this point earlier in the week, is that the fix or the attempts to arrest the spread are in itself economically submissive, right? They depress economic activity.
They absolutely do. And I think for an investor right now, aside from trying to tactically say, wow, we really have the makings of a crazy rally off the lows, even though it's not going to be the low, that's the tactical side. But step back and say, does it make sense that 1/6 of the value of corporate America is gone in 7 days? Does that make sense? Were we 1/6 too expensive a month ago? And I think that's what you have to try to figure out. And then you look at historical experiences when the market is this exactly depressed and oversold in a short period of time. And if you look at a few months, it's usually found its footing and picked up a little bit. If you look at the spread of dividend yields to corporate bond yields, not even treasuries, they're looking very dramatic in terms of how much of a buffer might have been starting to build in equities. But, we overshoot to the upside, and you're going to overshoot to the downside.
So Bernie Sanders' chances are rising. If you look at some of the betting odds and some of the polls, in fact, a California poll show he's in the lead there ahead of Super Tuesday. Is it a coincidence that this is happening at the same time that the markets are tanking, or is it part of the narrative?
It's hard to tease it out, only because the pattern has been, as Sanders' nomination odds have gone up, President Trump's reelection odds have gone up. It has been in lockstep. Maybe that relationship is going to change. I do think it's definitely a factor in retail investor sentiment, maybe professional investor sentiment, to just say, look, we kind of thought the market was going to, at best, go to sleep for a few months during the campaign, and maybe it'll go to sleep at a much lower level, and what's the rush to do any buying here? Because we do have that big unknown. And of course, as I said, maybe that relationship is going to change in terms of re-election odds.
With the coronavirus, and that it's hurting the economic outlook, and that raises Bernie's chances in a general election.
That's right. Oddly enough, the betting odds are not yet really showing that, but who knows if that's accurate.
Finally, Mike, you mentioned, of course, comparisons to many years ago at this point, 19 years ago. the market dynamic has changed dramatically. I mean, we didn't have algorithmic trading the way we did now. We didn't have the rise of ETFs and/or index funds being so preponderant. I don't know how that impacts things. I know that there are headlines that can trigger algorithms because they say if this, then this. But that has to be playing a factor.
It is absolutely playing a factor, David, in the velocity and how comprehensive the selling is in a short period of time. So if nothing else, it is exactly doing that. And so this very old-time rules of thumb, right? On a given day or a few days in a row, if you get 90% of all volume to the downside, that's usually a market getting sold out and washed out. Well, when you are essentially trading the indexes all the time, that's exactly more likely to happen if you're going to have the most stocks down. Another thing is you didn't have, certainly in previous periods, these big systematic strategies that essentially take their cues from what the level of volatility is. And so if the volatility level is low, we're going to take more risk. We're going to add it on. We have, the math works in our favor in that way, and it unwinds just as fast. And so, again, I do think it's changed the rhythm and the pacing of how these things go. I'm not sure it has changed kind of the human psychology of how people react to sharp moves in prices and what that means for kind of the bottoming process with regard to psychology and price.
Yeah. Well, Mike, thank you. Speaking of bottoming process, the S&P right now down about 3.3%. We're down 10.8% for the year. Let's take a break from the markets for one moment and get back to our headquarters. Sue Herrera joins us for a news update. Sue.
Good morning, David. Good morning, everyone. Here's what else is happening at this hour. The Turkish military saying it has struck 200 Syrian government targets, killing more than 300 Syrian troops. This is in response to Syrian attacks that killed 33 Turkish soldiers on Thursday. France, Germany, and NATO are among those calling for a de-escalation of that situation. NATO's Secretary General Stoltenberg saying peace in Afghanistan is, quote, closer than ever before. Stoltenberg commending the peace agreement between the U.S. and the Taliban that is set to be signed tomorrow.
The government of Iraq has confirmed to us their desire for continuation of the NATO training, advising and capacity building activities for the Iraqi armed forces. And we will only stay in Iraq as long as we are welcome.
And a high-speed chase in Los Angeles ending with a violent crash. A warning that what you are about to see may be disturbing to some viewers. Police following a driver who clipped another car, spun out of control, ejecting 3 passengers before slamming into a light pole. Fire officials say 4 people were injured. 1 teenager is in critical condition. You are up to date. That's the news update outside of the business world. I'll send it back downtown to you, Carl.
All right, Sue, thank you very much. Dow down 958 or so. We would remind you that the S&P and the Dow are basically back to levels that we last saw in August. We're monitoring the headlines from the World Health Organization briefing. The wires are saying that Fauci of NIH is briefing lawmakers. We'll watch for that as well. For more on the spread of the virus and how the U.S. healthcare system is set to deal with it, let's bring in Firefly Health Executive Chairman, former Athena Health CEO, Jonathan Bush, who's here at Post 9. It's always good to have you. Welcome.
It's nice to be here. I'm glad I was in town.
How would you grade our infrastructure right now in terms of response?
Well, I would say what we're building is really great. How built it is and how ready people are to use it, we'll see. Obviously, in a situation, epidemic or pandemic, going into a place with lots of other infected people is a bad idea, especially if you can be treated virtually. So folks that are members of Firefly or Teladoc or other stocks I know you talked about earlier, they're going to do better. And our infrastructure can flex. Our virtual infrastructure can flex up much more easily than hospital beds and emergency rooms can flex up. And most of the treatment is stuff that can be delivered at home as well. Things we can do right now, of course, we can get flu shots and wash our hands and fist bump.
But that consultation that's digital now, this will be the first real test of that at scale.
That's right. And I'm very interested in digital care delivery. I think that we have enormous bloat in terms of physical plant as we look around that beautiful old building hiding behind the screens here. And, it's sort of an obsolete thing, but we're in it for the showpiece. Hospitals in many ways have a similar, kind of sweetness, but uselessness especially in areas of low-grade infectious disease that swell up and contract.
But in emergency situations, that's another thing.
Well, no, even in an emergency pandemic, when we go from epidemic to pandemic, which very likely we will, it's a matter of, terminology, but it's in the U.S. It's silent for 14 days before it speaks, so it's very hard to imagine not. So far, we don't have a lot of cases, but virtual medicine, actually, like what you get in a hospital, right? The diagnostic equipment is increasingly small and digital. Your last guest was talking about the test, which could be administered at, literally delivered on Amazon. There's more and more and more that really allows us to unbundle what we think of as the hospital. Not today and not for everything, certainly not for a bombing, which, I'd want to be nowhere else but Boston, Mass, if I'm going to be in a mass casualty or somewhere like New York because of those hospitals. But most of what we face are socially determined or infectious diseases that are better treated virtually.
So you come from the healthcare world. You're in the healthcare world. What are folks around you in that environment, CEOs or doctors that you're talking to, saying about the risk here in the U.S. of coronavirus?
Well, I think, the one thing that everyone does is sort of go to worst case and say, like, how resilient are we to that? And it's sort of a really bad flu, and we do that every year. And the basic attack pattern is a known one. Try to encourage people to get flu shots and disinfect themselves. This is sort of 10x the virulence, so maybe try 10 times harder, but the same message. Do a lot of biosurveillance in the beginning. If somebody might have it, send them for testing. Not because it'll make them any better, but because it will. A stock went up. Good line. But because that...
The applause is a 44-year veteran is retiring today.
Oh, beautiful.
Yes.
He made it.
Your point, though, about virulence and washing hands.
Yep. And getting the flu shot.
Yeah. Getting you so that you're not in the hospital to begin with.
Exactly. Yeah. And then we send people for testing early on, and we do that with every flu cycle to make sure we can track it, check its type, see if our if our antivirals are working for it. But once it's spread, once we all are kind of getting the flu, the test doesn't matter anymore. And this will be very similar. And similarly with the stock market, once we sort of have it, and we're all infected, and we know whether we've kind of used stimulus as a lifestyle drug here of late. So do the margin calls and the debt calls hurt us more than we thought, or do we absorb that? And then it's like, all right, it's coming through. It'll go through again next year, and okay.
Well, that is why our market, of course, is reacting. It's in large part to the uncertainty.
Right.
At what point do you think, Jonathan, we're going to have more certainty? I mean, I would assume you have a lot of questions, as we all do, just about simple facts about the virus that are yet to be fully understood.
Right. It's funny. Osama bin Laden and well-known attackers all over the world try to do it threes. The first one, you're like, I got that. And the second one, whoa, and by the time the third punch comes, you sort of had enough. And so I keep thinking, first one is just the supply chain. Second one might be margin calls or debt calls. What might that third punch be? And one thing you guys can do is really think it through so that we feel resilient. It's not the first time we're having that thought. We're not having a black swan moment when that third one comes. The two I'm thinking of are supply chain, not the disease itself. Supply chain and debt on margin calls. And then not a lot of room to land left on the backside because we've been playing with debt like a lifestyle drug.
How much does the asymptomatic nature of this one change the game? Being able to spread and having no clue that you're sick.
Right. There's the row score, which is the virulence, the spread rate, like Ebola's a 50, 50. Like this one doesn't have to have as high a spread because it can stay, can have a really high spread. Excuse me. Doesn't have to be that virulent because it can stay quiet for so long before it speaks up, and that will become more relevant. The good news is on the back end, it's a really bad flu. It's not bleeding out of your eyes.
Right. That is, when Mulvaney's on the tape this morning saying it's not a death sentence, that's true.
Correct.
Right.
And in fact, the death sentence rates we've been seeing are in China, which, all due respect to China, I'm sure it's great. Wholly different healthcare infrastructure than what we've got. Seeing them frantically build these tombs, that's not the kind of hit rate that disease will have here. So
do you have concerns about sub-Saharan Africa?
Yeah, sure. Every fragile ecosystem, when a invasive species of any kind comes into a fragile ecosystem, my heart aches a little. And certainly every fragile ecosystem in the world, including China, right? They're not as, down below the level of that roaring economy, which largely is codependent with us. It's a fragile billion people or couple. So obviously, sure, places that get that and aren't ready, don't have a lot of infrastructure to absorb it. I spent most of my life complaining about the excess capacity and the bloat in medicine. Now I'm like, a little bloat, maybe not so bad.
I wonder, these kinds of things can change behavior. It may be that we stop shaking hands, for example.
I had my meeting this morning with a longtime friend. I went in for the hug and I got a fist bump.
Yeah, you did. But at the same time, I wonder whether you seem to have entered a market in which place your product may be particularly well suited.
That's right.
Is there going to be even more growth and changes in behavior as a result of this that potentially help?
Right. When people actually break down disease and break down the drivers of healthcare spend in the country, we built this system around traumatic injury and infectious disease, but most of the stuff we have is behavioral determinants of health, where a doctor is valuable, but the idea of the stethoscope is complete artifact. And so over time, as we go through these cycles and realize how much of the care was treated digitally or virtually through less invasive and less intensive, asset-intensive things, we'll go, oh, yeah, and it'll become the new normal. And so these are horrible. I wouldn't wish this on us or anyone. But when you take a blow and you recover and you realize what worked, your acceptance of it the next time around goes up.
So do you have any opinion or things that you'd like to hear from our public health authorities, from President Trump, as the nation braces for this coronavirus?
Obviously really candid, really real time. Johns Hopkins has a great tracker that I look at every morning, being really real about it so we know which part of the journey we're on. Denial is a terrible part of every journey. In every chapter of my life, I have found that denial was not a helpful portion, probably necessary. Obviously, China has been struggling with denial two epidemics in now. But obviously, we don't want our government to do that. I don't think this is anybody's fault here. And being radically candid right away, and letting the hits come and letting people absorb and then go, okay, that was it.
If you're framing this, though, as somewhat of an inevitability, right? The spread that
I'm non-scientific, two-bit entrepreneur.
But the notion that we're going to live with it.
Yeah.
What do you make of, for example, this morning the Swiss government is looking to put a stop to gatherings of 1,000+ people, sports events, concerts, what have you? Reasonable or not?
It's a yin-yang based on your values, right? Sure, I want to put it off. I don't want to be the guy who falls next. I want to be on record as doing the best I can. If this was something with an Ebola-like output on the end, you betcha, right? But because of the fact that the economic consequences are so vast, right, and the clinical consequences are problematic, but not devastating.
Mild relative to Ebola.
Mild relative to what they, right, exactly. There's a legitimate balance there that I think, and the thing that governments might really avoid doing, I hope, is thinking one and saying the other. Like saying we're doing everything we can, but saying I really don't want to see a bump, a drop in the economy. And then there's that dissonance, which takes our already piss poor, trust levels. And then when you have distrust, like what else do we not know? That's when markets collapse, is what else do we not know? So just get it out, get it real. And, say what you want about our president. He doesn't have a hard time saying what he thinks.
No,
so maybe that won't be the thing that goes wrong.
No, he's very focused on that. So
yeah, well, as long as he says what he's thinking, I think that'll be fine, I think in Switzerland, as long as they don't have two tracks when they're thinking and when they're saying.
So, speaking of the stock market, we're watching tick by tick down 1,000 points to 1,085 was the low.
Yeah.
Health insurers have had a really rough week. In fact, looking at their worst weekly loss in 2 decades.
Sure.
Political?
People get sick, they file claims. Everything's got a claim associated with it. They are all moving to risk contracts where that risk will move down onto things that are more scalable and more able to absorb pulses. Insurers that are on Firefly, paying for Firefly, won't pay more when suddenly all of Firefly's members, hit their care team and say, what do I do? Do I stay home? But today, everything in medicine, even a flu shot, turns into this ridiculous insurance claim that makes its way up, through AthenaNet or whatever into the insurance company, gets turned around. And if there's going to be a pulse in that's going to hurt for a while.
So you don't see it as political. You see it as related.
No, heck no. If you think there's a non-zero chance that a lot more people are going to file a lot more claims, you maybe don't want to go buy a whole lot of insurance company stock in that moment.
Jonathan, really good insight. Thank you.
Sure.
Appreciate it very much.
Pleasure to be here.
Jonathan Bush.
Good to see you guys.
Let's get a check on where the major averages stand at this point. We're trading right around the lows of the session. Dow's down 943 points. We were down over 1,000 just a second ago. S&P 500 looking at a decline of 3.4% on top of the sharp losses we've already seen this week. The NASDAQ down a little bit less than the others, though we've got every sector down within the S&P 500, and we're looking at a more than 15% slide off those record highs where we were just a little over a week ago. St. Louis Fed President James Bullard weighing in this morning on the virus concerns. Our Steve Leisman is back at HQ and has that for us, along with that moving target that is where the market thinks the Federal Reserve rate is going. Steve.
Yeah, really good way to characterize it, Sarah. First, let's talk about the markets reacting to comments this morning from St. Louis Fed President Jim Bullard, where he appeared to lean against any near-term rate cut. Here's a quote from his speech. Further policy rate cuts are a possibility if a global pandemic actually develops with health effects approaching the scale of ordinary influenza. But this is not the baseline case at this time. Bullard said the Fed is monitoring the virus, but is in a, quote, good position because previous rate cuts are still working their way through the economy. His comments echo and even further the reluctance of other Fed officials to affirm the very aggressive pricing in the market for the Fed to act and to act soon. Here are the probabilities Sarah was talking about, and these are within the last half hour. As she said, they have moved around. 100% chance of a March cut, which is the meeting in a couple weeks, but a 63% chance of a 50 basis point cut at that meeting. So if it doesn't happen at that meeting, let's look at the next screen where it shows that second cut would come in April with a 70% probability now. June, a third cut, 51%. And this is new today, guys, a 57% chance of a fourth cut in November. So far, Fed officials have pretty uniformly sung the same tune of waiting and seeing until the impact of the virus shows up in the data. There's some support for that among Fed observers who question what good a rate cut would do. But the other side argues that the market in free fall creates its own economic reality, and rate cuts could perhaps stem that route, Sarah.
Yeah, I've been listening to your debate all morning long on this very subject. It feels like the Fed, well, at least James Bullard, I don't know where the center of the Fed is these days, is not at the place that the market is at. And that's going to be a bigger problem for the market. And they risk making the sell-off worse if they don't step up and say, we've got it under control. We're on top of it and we're looking at action. I know they always say that sort of, but there's no urgency in it right now.
I think what's interesting, Sarah, is as each day goes by, the numbers we put up of those probabilities seem to get further away from what the Fed is saying. And I have been struck by how uniform those comments have been. Bullard today, Evans yesterday, Clarida earlier in the week. They do not want to say to the market, yes, we're going to cut in 2 weeks. It wasn't a problem for the Fed 2 days ago when the cut was priced in April because the Fed had time to figure that out. Now the Fed, I think sometime in the next couple of weeks, is going to have to either, I guess if they don't say anything, they're going to be affirming what the Fed is, what the market is pricing, or at some point say something to try to get in line with them. But the gulf or the split between the market and the Fed rhetoric seems to get wider, I want to say, by the hour.
Yeah, but Steve, you've been making this point all morning, and I've been hearing it from others as well. A cut does not get people to go back to factories or have the line go. It doesn't have people get on airplanes. It doesn't have people go to conferences or concerts, as you pointed out. It doesn't do those things.
And it doesn't bring supply in from over in China. That's true. And that's the reluctance, David, that I'm talking about. And like I have been reporting, there are many people who normally would be on board with a Fed rate cut here that seem to have their misgivings about this. I think the issue becomes the stock market. I think the issue becomes the alignment of where the market is priced, especially in the bond market. Because, David, there's this term we call behind the curve, which usually is a metaphor. But in the case of the Fed, it's actually, it's literal in the sense that the 2-year bond now is priced. I don't know how many rate cuts. Maybe Sarah has that in front of her right there. But trading substantially below where the Fed funds is right now. I think it was 0.9 earlier today. So how many rate cuts is that? The Fed is literally behind the curve of where the market is, and you would expect over some period of time, David, that those things have to even out a little bit.
And the other thing I would say to that argument, David and Steve, is that at this point, you know, with the market dropping so far, so fast, that in itself can become a vicious sort of spiraling, self-fulfilling prophecy of economic pain. And if the Fed shows that they're on top of that aspect of it, at least, then there's something they can do.
Can I I think that's absolutely right. If I could throw this back at Faber into his, among his areas of expertise is debt and hedge funds and those sorts of things. Nobody has said that that's an issue yet, but at some point you have a drop in the underlying equity or the collateral to the loans and the leverage out there, David. You know, if you look at what's happening in the high yield space, there have been some spread blowouts. Some of the ETFs that trade the junk bonds have been trading down quite a bit. So, I mean, at some point, do you start to ask the question about that?
You do, but I don't think we're there yet in terms of it being a real problem, at least not from what I'm hearing. Broadly speaking, certainly not in the credit markets. Yes, high yield, and Sarah's made this point, has certainly moved up. That is a result of a number of things, but not hearing much in terms of any blow-ups in hedge fund land or anything of great significance there. That can change quickly, Steve, and we're certainly going to keep an eye on it.
Exactly, and we'll wait for you to report that, David, but you got to keep your ear to the ground on that, and I think the issue that Sarah brings up at some point, does the Fed need to step in simply to stem the rout in stocks?
Okay, Steve, thanks for the good conversation. Steve Leisman. Let's check in with our Meg Terrell now. She'd give us the latest on the coronavirus headlines back at our headquarters. Meg.
Hey, David, the World Health Organization raising its global risk assessment for the coronavirus's spread and impact to very high, the same level as it's had for China since late January. Director General saying there are more than 20 vaccines in development globally, with several in clinical trials, and the first results are expected in a few weeks. This as the virus has reached more than 50 countries, with more than 83,700 cases and 2,860 deaths. The first case reported in sub-Saharan Africa, an Italian patient in Nigeria. Switzerland banning public gatherings of more than 1,000 people. Case numbers climbing especially quickly in South Korea, now to more than 2,300. In Italy, more than 650 cases. The U.S. getting prepared as well. The CDC expanding its testing criteria to include travel history to more affected countries or severe respiratory disease and fever with no other explanation. Guys.
Meg Terrell. Meg, thank you. Taking a look at the markets here, 11 sectors down in the S&P. I'm just looking at some of the week-to-date declines because we are in our worst week for stocks since the financial crisis. All groups are down double digits, guys. Energy, by far the worst performing sector, down 18%. Real estate and technology are right behind it. Healthcare and industrials and staples have held up a little better in staples. The only positive one for the week is Clorox.
We're off the lows by about 200 points. Kudlow is on the tape right now. He has said that supply chain problems in the U.S. have not yet surfaced. Doesn't mean they won't. And also added that other G7 countries have not seen any economic breakdowns over the virus, which, take a look at some of the numbers that have come in. We did see consumer spending in France and Switzerland this morning negative by about 1%, worse than expectations. But
Northern Italy, which is an important economic zone for the overall country, has certainly come to something of a standstill, I think. I don't know what the numbers look like from there. It's all anecdotal, but it does appear that it's slowed down dramatically.
It doesn't help that they haven't grown in about a decade. But the problem is, the data looks old right now, and the market is obviously leaps and bounds ahead of the data. But maybe it's good that the consumer confidence number here in this country is strong, and we've got a good footing. And if this doesn't come out to the worst fears of the market, then you listen to a Dr. Jeremy Siegel of Wharton or someone else who says that this is way overdone. The problem is you just don't know what kind of trajectory the virus is taking and then what kind of economic shock that's going to bring.
Also, gold is getting lots of people's attention, down almost $60 to 1583. Let's get to the CME Group and get the Santelli Exchange. Good morning again, Rick.
Good morning, Carl. I'd like to welcome Jim Caron, investment manager with Morgan Stanley Global Fixed Income. Jim, let's get right into it. If we did 50 basis points yesterday or the day before today, and the market then proceeds to go down triple or four digits, that's like throwing it into the wind. The Fed should never throw in 50 with what we have to go. Sarah, back to you.
Rick, apologies. We got to get to Larry Kudlow at the White House.
You got millions of people trading it all around the world. But I just think everybody, whether you're an investor or whether you're, ordinary Main Street person, people should not overreact. That's the important thing. They should not overreact. In America, we have an incredibly strong public health system. And as I said to Stu Varney, President has taken rapid-fire, unprecedented actions to help protect in the event of emergency or further deterioration. I think these are very good things. They're very constructive things.
Larry, there's been rumors on Wall Street for several days now that the president would consider more extreme measures to respond to this, potentially even up to suspending the tariffs on China as one emergency measure due to the virus. Is the president considering that or any other response measure here?
Eamon, there's nothing definite that I can report. There's a lot of conversations in and out of the Oval Office. I was with him yesterday for quite a while talking about one thing or another. We're dealing with this almost a day at a time, and we have no precipitous actions right now. Again, it's sometimes a hard case to make in the middle of one of these crises, which is part psychology and part fact, but I just don't think anybody ought to panic right now, and we are going to stay the course on our policies, tax cuts and deregulation and energy and trade, and it's worked. It's worked, and the economy is sound. I'm actually still watching China. People have moved from China to Italy or other places, but I'm still watching China, and I've gotten to know Tim Cook very well, CEO of Apple. He's a brilliant man, and I was just really interested in the interview with him yesterday because he was rather optimistic about reopening factories, and I guess the Starbucks people feel the same way. And the other thing is, Eamon, just on the economic stock market point, it may change and it may worsen, but right now, these sort of real-time Fed, these regional bank surveys, people should pay attention to them. They're sending off good signals on the economy. And the numbers we have in hand in January exceeded expectations. That's why that Atlanta Fed thing is at 2.7. Now, we've got another month to go for the quarter, and then after that. So we will see. But no, I don't think we're going to take any precipitous policy moves here, at least not at the present time.
Larry, how much more shot can the market take before there's long-term effects on the economy? What do you think? Keep you in your lane.
Well, yeah, thank you. Look, the markets has short-run correction, and I guess it's 10 or 11% or something. We've been through this many, many times before, and I don't think, even though it's a front-page story and nobody likes to see their asset values go down, I just don't think at this point it's going to have much of an impact. I'll qualify that. Depends how long this lasts. Depends how deep it goes. But I could cite a number of historical experiences. The one I remember the most. Remember, I was a Reagan Cub Scout way back when, and I remember the 1987 market crash. And I remember President Reagan going up and saying the economy is fundamentally sound. And actually, the economy grew by 3-4% for the next couple of years after that crash. And I think President Trump said it here in this room 2 nights ago. We just think the economy is sound, and therefore, I just don't think this short-term stock market plunge is going to have any long-term effect.
The R word at this point, in other words.
Yeah, not at the moment. No. Yes, Deborah.
If you had a friend who was thinking of taking a cruise or going to China, what advice would you give them?
Stay home.
Larry,
what effect do you think this will have on the president's re-election campaign?
I think the way he's handling this will have a very positive effect on his re-election campaign. I think that, so I'm a longtime Trump friend and watcher, and now, of course, the last couple of years I've been working with him, for him. I think it was one of his best news conferences I've ever seen him give, and he laid it out. Again, really historic and unprecedented actions. And this is a government-wide effort. And so I think folks are going to look at that and say, you know what, he was doing his job very well. And I think, therefore, at the end of the day, it's going to actually help them on that.
Larry,
Yes, sir.
what emergency powers does the administration have to ramp up domestic production of N95 masks and other personal protection equipment?
I wouldn't want to go into specifics. There are things we can do to help. There are things we can do to unclog log jams if they exist. I just don't want to go into any details on that right now. Just a couple more. Yes, ma'am.
Can you help clear up some confusion about communications having to be funneled through the Vice President's office? There are many officials who are saying that is what has to happen, but on the record, the Vice President's office has denied that. So can you clarify, do government agencies need to clear their coronavirus communications through the Vice President's office?
There's a lot. Look, we always have coordination here. Always. Right? The NEC has to clear things. President is the ultimate clearance authority. The Vice President's running this task force. We're just trying to coordinate our messages. It's a government-wide operation, and that's not an easy thing to do. I will say to you, though, no one's being stifled. No one's being told what to say. Look, you've got veterans. Again, I come back to this point. You've got veterans in NIH and CDC with the immense knowledge of these things. They've been through this before. And we are all ears. We want to hear what they have to say. We want to hear what they tell us. So there's a big difference between stifling and coordinating. And I think you have to coordinate. It's a big government. So, no, I don't see a problem there at all. I don't see anything wrong with that whatsoever.
But once again, it's a conflicting message because officials on the record have said from this administration that there is no approval process. But you're telling me that there is?
There's no hard and fast process, no. But people have common sense. So you've got this task force. Actually, I'm a member of the task force. And there's a lot of coordination going on right now. Because here's the thing. This may not be what you're looking for, but I just want to tell you, this is such a serious matter that not only do we want all the information we can possibly get, we would like to have coordinated messages just to stop any confusion with the public. And it's a real hard thing to do. But there's no hard and fast, you can't say this, you can't say that. No, that's not the case. But we're sharing information across a multiple number of agencies, and we're doing it through that task force. And we're just trying to coordinate, so we're speaking with one voice as much as possible. That's all I'm saying.
Is the CDC free to talk about coronavirus?
You mentioned in the Fox interview that the president's been on the phone quite a bit. Has he spoken to CEOs of these different companies impacted by this? And which companies have you guys had a chance to speak with?
Oh, I wouldn't divulge that. That wouldn't be right.
Is it mostly the travel industry? I mean, can you give us an idea?
It's just across the board. We're always in touch with CEOs. One of the great parts of my job is I've gotten to work with, meet and get to know a lot of these CEOs, many of whom are just brilliant people. And that's why I cited the Tim Cook interview. Tim Cook is a terrific businessman, and he runs a great company, and he knows a whole lot about China. And he would not have said what he said if it weren't true, or at least on the ground what he saw. That's very, very important. But we're keeping an eye on everything right now. We understand this is difficult, but sometimes the psychology is a lot worse than the fact. And I understand that. That's a perfectly understandable human trait. You plan for the worst, but it doesn't necessarily mean the worst is going to happen. Just something else.
Anecdotal, the Tim Cook story, and you've said that before.
Yeah.
I mean, sort of broadly, what have you done, and what did you do back in those meetings weeks ago on this to try to deal with the supply chain problem?
Well, the government doesn't run the economy. I mean, we can learn and report on it. We can't control that. If China's taken tough steps and closed down factories or whole areas, we just have to live with that. As you know, in this room, I've said several times, the president has from day one wanted to engage with China. He's talked to Xi, wanted to help China. We wanted to send our experts over weeks ahead of when they actually went. We're working with the World Health Organization as well. We're only as good as the facts, and the facts may be harder to come by in some cases. We can't control that. My point about the supply chain, I understand that the economics world and the investment world is worried about that because it could, slow down growth for a couple quarters. I was scanning the Wall Street Journal today, for example, looking at various stories. North American auto production is proceeding apace. Now, there are problems overseas, especially China. China auto production is terrible, auto sales are terrible, and they're going to have a very poor first quarter GDP. But on the whole, again, looking at these regional Fed reports, that's the best I can do right now. We don't see any evidence of major supply chain disruptions. I'm not trying to say nothing's happening, and I think there will be impacts, but to be honest with you, at the moment, I don't see much. Now, that may be ahead of us because the next few weeks in March will be important, and we'll get new information on that. So far through February, it looks okay, and I think investors and ordinary families should, take some comfort from that. So we'll take this a day at a time. Thanks very much. Appreciate it.
G7 is still on? Thank you.
Yes, it is.
Both are finance ministers and the Leader Summit.
Well, the Leader Summit's in mid-June. We had our meetings yesterday. We finished up today. Still on. Stay tuned for more.
Thank you. Thank you, Larry.
Thank you. Appreciate it.
All right, that is National Economic Council Director Larry Kudlow, now a member of the task force, which is tasked with arresting the coronavirus spread, saying we're not going to take any precipitous policy on the economy, at least not at this time. Says we're dealing with this almost a day at a time. Says markets have gone too far, expects it to come back, urges people not to overreact. Says the president's talking to CEOs from industries across the board. We're keeping an eye on everything, he says, and adds that in terms of medical personnel, no one is being stifled. No one is telling anyone what to say.
The human toll, Carl, of course, the top concern, but he did also say, I don't think at this point it's going to have much of an impact, talking about the market reactions, potential impact on the real economy, believes that will be contained. And now let's bring in Ken Langone, who joins us on the CNBC Newsline. He's a billionaire investor, co-founder of Home Depot, CEO of Invimet Associates. Ken, good morning. Great to have you with us.
How are you today?
Doing quite well, Ken. I'm hoping for your perspective, first of all, on this market reaction and the administration's handling of this challenge so far.
Look, this is a scientific challenge, not a political issue. And I'm comfortable that the best scientific minds in the world right now in this particular area are focusing on it. I think it's a serious issue. I think it's an issue that we have to be diligent with. But on the other hand, when you look back in times past, whether it was the HIV in the early 90s, whether it was Ebola, SARS, you go right down the list. I think that with everything's being done right now that should be being done, and more importantly, I think that the public is conscious of what it can do. Pretty simple stuff. Wash your hands. Keep your hands away from your face. If you have a disinfectant, use it. This is all pretty simple stuff, and everybody's capable of doing it. I'm not suggesting that this is not a serious issue, but I'm saying to you that as far as I can see from the standpoint of the stock market, the reaction far, far surpasses the issue. And I guess Kevin Warsh was on Squawk Box this morning, and he said something, and I heartily concur with him. I wish the Fed had done other things in these previous 9 years to have more in their toolbox than they have right now. That said, I would rather own a high-quality company that yields 2.5%, 2.75% dividend than buying a long-term bond where I know I'm pretty much signing up for losses. So I think it's the time to be cool. I think it's a time to be rational, and I think it's certainly a time to make certain that our leaders, all sides, all parties, get off the issue of the politics and get on the issue of the science. And by the way, Carl, that includes, to me, the media as well. I think this hysteria is being fed in part by the media.
And that's, we do have you on TV right now, so you are a voice of reason perhaps on the media right now. And so I want to ask you along those lines, you've dedicated a significant amount of your time and financial resources to public health. The NYU Langone Medical Center has your name on it. Has this particular challenge exposed any issue with our health system's preparedness for this type of a virus? Or on the contrary, do you think the United States and our medical system is in a good position?
I think our medical industry is in top flight shape. I've had the benefit of a memo from the dean last night, which went out to all of our trustees and all the people involved at the medical center. We've taken every imaginable precaution. We're dealing with it. We know how to deal with things like this. And I think we're no exception. I think if you go to all the great medical centers in the United States, and indeed around the world, they're not taking anything for granted. On the other hand, they're approaching it in a very rational, calm way, as you should. And so I'm very comfortable. I'm not going to change my life, or I would expect most people won't change their life. I had a chat with a vice dean for research at NYU the other day, and I talked to her, and she assures me that as of right now, she's not that concerned. We're taking the necessary steps, but you have to let it unfold. And as I said earlier, the fact that you've got the most competent and most able scientific minds around the world focus on this right now, I'm absolutely convinced that we'll look back at this in 2 or 3 or 4 months and say, my God, what a fabulous opportunity it would have been as an entry level to go into the stock market or to add to my positions.
Well, given that, Ken, what, if anything, do you think the Fed should do here? There are some calls we had on this morning on Squawk Box for some coordinated action among central banks. Is that necessary? If in 3 to 4 months we'll look back on this as perhaps an opportunity that some people had to buy stocks?
So what coordinated efforts can they have? Interest rates are so low now. As I said earlier, my hope would have been that they would have taken rates up over these previous 9 years to a level that effectively that's one more tool in their kit, because if the rates are higher, they can do a meaningful cut. But right now, look at where interest rates are. What else can the Fed do? I suppose they can do more QE and all that kind of stuff, but I think that's not the issue right now. The issue is not an availability of money or a shortage of money. There's plenty of money around. And all you're going to do if you lower rates, you're going to just make the argument for corporate dividends that more compelling.
That's for sure, Ken. I'd love to get your take. We're trying to get people not to overreact, and your point is so right. It's absolutely true. Are you thinking more about the consumer's behavior or companies' behavior? When you got Nestle and JP Morgan cutting international travel, Microsoft and Facebook canceling events, which is more important to pay attention to right now?
Well, I think the corporations taking those steps is sensible. We don't know how bad this is. We don't know how profound it is. We don't know how widespread it is. So I think what's being said is, if you don't have to make that trip, don't make it. But on the other hand, I don't detect any kind of panic. The airlines canceling flights with simple reason. When your load is down 75%, why lose money? Why? And more importantly, why provoke the possibility of bringing the disease back if you go over there? So right now what I see are all these precautionary steps, which I think are very temporary in nature, and I think they will prove on reflection to have been the right steps to take. In regard to the consumer, I think the consumer has to be careful in how they deal with themselves personally. As I said earlier, wash your hands, don't touch your hands to your face. If you're around somebody that's coughing and wheezing and sneezing, be careful. Don't put yourself in harm's way. But I think right now what I see more of a problem than anything else is this panic. And there is a panic going on. If you look at the market's down, 4,000 points in 3 days or 4 days? And that's hardly stability. But we'll get through this. We'll get through it fine. The important thing, I think, is let the scientists do their work. Let the government leaders do their work. I think, by the way, the president's early actions regarding blocking off people from coming from certain countries was brilliant, and it was courageous, and he did the right thing. I think, for example, this committee, this task force that's been appointed, have all the best minds in America involved in it, and I think it'll bear fruit. But I urge everybody, be calm, be cool, and be collected. Don't let your emotions run away with you. There's plenty of time to worry. Right now, let's try and do as much as we can to continue our normal lives. But my God, don't give up on America and don't give up on the world. It's not that time.
All right. Ken Langone, thank you. It's Ken Langone, billionaire, investor, and entrepreneur with a message of calm for the market.
Meantime, Scott Nation, CIO of Nation Shares, and Stifel's head of institutional equity strategy, Barry Bannister, joining us this morning. Guys, good to see you both. Barry, I mean, who would have thought that this came along, right, just when everybody was getting constructive from a cyclical point of view? Now we got people looking in the rearview mirror at the period post-August, calling it a Fed-induced breakout. What do we think now about global growth?
Yeah, it did come out of the blue a little bit, but if you look at it, I mean, a VIX of 49, the fear index is at 49. It was 44 in March of 2009 when the world really was coming to the end in an economic sense. So this seems to be a panic and overreaction, ready for a short-term bounce. I do think we need the Fed to send a signal with a quarter point very quickly, hopefully next week, maybe Monday. It's not the cure to the virus, but it is a signal, and
a signal.
I don't think that would hurt.
How does it help, Barry? If you can help viewers understand what a Fed cut does for the markets, the economy, what is the constructive element in an emergency cut?
Well, if you look at the 10-year break-even inflation, it's been plunging with the 10-year yield. If you look at the 5-year forward inflation swaps, they're also down. So they're not meeting their inflation mandate, and they probably do need to steer a little bit towards the easing side. Also, and I've been a critic, as you know, for a couple of years on the Fed policy, they had no business going to 2.4% last year or even staying at 1.6 now. When you look at what's called the G10 ex-US, the major countries in the West ex-US, they're at zero rates on a GDP-weighted basis. So our spread to them is so wide that it's at a level that it previously induced recessions within a year and a half. So there's all kinds of good reasons to cut, and it's a good signal.
Scott Nations, I hear the argument that this is a panic. I mean, certainly the VIX went from around 15 to 46 today pretty quickly, but we're back at October levels, even right now, which is not that far. Haven't lost all the gains for 2019. Is there an argument that this is really taking some euphoria or perhaps unnecessary exuberance off the table, but this isn't a panic at this stage?
I don't think this is a panic yet. And why do I say that? It's because in a real crash, you see discontinuous trading. That is trading that gets really sloppy. Nobody can understand what price they're likely to get. And while the numbers have been ugly, the trade has been relatively calm. You may not like the price you get, but you get the price that you expect. And while we're off more than 10%, again, there haven't been air pockets. It hasn't been discontinuous or ugly. And that's really the sign of some sort of a crash, is discontinuous trading. Now, what could cause that? If we have some sort of contraption, and every crash is husbanded by some sort of financial contraption that comes unglued, unwound, the worst possible time, and injects leverage. And what might that be now? It might be overnight repos, it might be illiquid ETFs. But when that happens, that's when we see discontinuous trading, and that's when we really see chaos.
So, Scott, so often when we talk about these drops, we talk about them as though the levels where we were trading right before them were completely rational by historic standards. I don't know that that's necessarily the case this time. So given where we are now, if we're talking about the S&P, if we do have a valuation adjustment, to where it's more in line with historic levels, and we are considering a short-term hit to corporate profits because of coronavirus. What do you think is a reasonable level where the S&P would be settling out along those circumstances?
I would think between here and another 5% down would make a tremendous amount of sense. But remember that if the Fed keeps rates too low for too long, and I'm going to disagree with Barry completely, I'm going to agree with Ken Langone. The Fed is the problem here. They've kept rates too low for too long, and asset prices got inflated into a bubble. It's not the first time the Fed has done this. They did this in the late 1920s. They did it in the middle of the 2000s, and we know what happened at the end of each of those decades. And this is not subjective. Look at something objective like the Taylor rule, which says that the Fed funds rate should be about 300 basis points higher. So if the Fed has been looking at the economy and can't find inflation, it's only because they've been using a 50-year-old measure that's outdated. All they had to do was look at asset prices.
Barry, I will read one line for you from RBC. Cutting now, when Fed funds is already 100 basis points below neutral, further cements the dangerous precedent already set that the only independent variable in the policy reaction function that matters is what the S&P is doing of late. Don't you think a cut is going to reinforce that view?
Yeah, a few things. One, the causality now runs from the stock market to the economy, not the other way around. That's just reality. And also, on the other speaker's point, yeah, I would like to wave a magic wand and make the trillions of dollars of debt go away, but the fact is it exists. And if we do raise rates to anything approaching Taylor rule, we're going to get a massive deflationary depression. I don't know if that would stand politically. And as far as RBC goes, if you look back to the fourth quarter 2018, the Fed only needed to touch the neutral rate to trigger a nearly 20% drop in the fourth quarter 2018 in the S&P. And I believe we had 1 month there where we were down about 2.5% on retail sales, which is the causality I referred to earlier. So, you know, it would be nice to take the medicine, but I don't think this is the time for experiments of, you know, after you're pregnant, it's a little late to become chaste.
So when Kudlow said, no, one thing to Barry, when Kudlow said literally 20 minutes ago that the stock market's not the economy, you don't think that's entirely true?
Well, I just look at, for example, the year-to-year S&P 500 correlation to the year-to-year consumer confidence. It's tightened up in the last decade. So, yeah, I think the wealth effect matters a lot for marginal propensity to consume by stock-holding individuals. We already have maxed out consumption and no savings in lower-income quartiles. So, yeah, I think the stock market does matter.
Scott, last word?
Carl, my point would be that this may not be the time to react for the Fed, but they've had the last half of a decade to do it, and they were cutting rates at a time when we had 2% growth here in the United States, which is not great, but pretty good, and a stock market at all-time highs up 30% for the year. And Neil Kashkari kept saying on Twitter they couldn't see inflation and they weren't going to raise rates until they saw inflation. Well, Mr. Kashkari, if you couldn't see inflation, it's only because you didn't know where to look.
Not until you see the whites of their eyes, to quote somebody else on that front. Scott, Barry, thanks, guys. We're working through some tough issues. We appreciate your time, as always.
Thanks. Carl.
Meantime, a global shortage of face masks has sparked a race between suppliers to rapidly produce and fulfill those orders. Seema Modi is in Aberdeen, South Dakota today with an exclusive look inside the manufacturing plant at 3M. Hi, Seema.
Hey, Carl, and pressure is building on 3M, the world's largest manufacturer of these respirators, to make sure every factory across the U.S. is operating at maximum capacity. In order to do that, it's increasing staffing and also expanding its assembly line with these robots to ensure that it can meet the demand. Now, there are a number of respirators that 3M specializes in. The most popular is this N95. It's designed to fit around your mouth and nose, and it filters 95% of airborne particles. Now, the HHS says 30 million of these N95 respirators are in stockpile, but it needs 300 million as the risk of the coronavirus becoming an outbreak here in the U.S. continues to rise. 3M is trying to accommodate the domestic demand, but also fulfill the orders that are coming in from around the world.
The global demand right now for respirators is very high because so many governments and hospitals are preparing, and 3M and other manufacturers are ramping up production as quickly as possible. But it is such a dynamic situation.
Making matters even more challenging, 3M just got done sending a number of products to Australia where medical workers were fighting those wildfires, and now coronavirus hits. Of course, a lot of the supply chain was disrupted in China, and that's why these factories here in the U.S., again, trying to really work around the clock, increasing their headcount and putting in more hours to get more of these masks to hospitals across the U.S., guys. Back to you.
Seema, it's literally the story of the month. And then 3M's performance, which did remain one of the only Dow components green today. Our Seema Modi in South Dakota. Markets about to close in the UK and continental Europe today. Coronavirus fear sending major indices down another 4%, tumbling further into so-called correction territory. It was the airline stocks that took a hit after a warning from AIG, the parent of British Airways and Iberia, expecting the virus to hurt full-year earnings and bookings. Discount carrier EasyJet with a similar warning. Meantime, the stock 600 finishing February with a 9% loss. That is the worst monthly performance since 2011.
Let's get the latest on more news in a news update. Sue Herrera has it at headquarters. Sue.
Indeed, I do, John. Thank you very much. Here's what's happening at this hour, everyone. In Geneva, the head of the World Health Organization raising his assessment of the seriousness of the coronavirus outbreak, but also saying the virus can still be contained.
Our epidemiologists have been monitoring these developments continuously, and we have now increased our assessment of the risk of spread and the risk of impact of COVID-19 to very high at global level.
Tokyo Disneyland and Disney Sea closing until March 15th to slow the spread of the coronavirus. That's following a government request to cancel events where large crowds gather and could spread the infection. And in the Middle East, Palestinian protesters clashing with Israeli security forces in the West Bank city of Hebron. Rocks thrown by protesters were answered with stun grenades from Israeli troops. The confrontation occurred during a demonstration marking the 26th anniversary of a massacre at a holy site to both Muslims and Jews. You are up to date. That's the news update this hour. Back downtown to Squawk Alley. John, I'll send it back to you.
Thank you, Sue. And China, meanwhile, looking to its largest names in tech to control the outbreak of the coronavirus. Deirdre Bosa explains from One Market in San Francisco. Deirdre.
Hey, John, that's right. The Chinese government is tapping their enormous reach to spread critical information and try to control the outbreak. Now, Alibaba has more than 700 million users. Tencent's WeChat app has well over 1 billion users. Now, they do more than e-commerce and social media. And for many people, they are an indispensable part of their lives and their work. So these are a few screenshots from my own WeChat. In Chinese, it tells users the latest coronavirus numbers and points them to resources like official accounts and latest articles. Now, this would be as though Facebook's platforms and Amazon were harnessed here to distribute the latest governmental information, official information, and tools in the case of an outbreak. The Chinese giants, though, they go a step further. They're helping to track users' health and whereabouts. Alibaba and Ant Financial are reportedly exploring a nationwide rollout of a rating app to help governments control travel, while Tencent has created a similar program in a southern Chinese city. Now, in Shanghai, the local transportation authority is asking subway passengers to scan QR codes so that they can trace people in close contact with suspected patients. Now, what do they get out of this? Well, authorities, they get to tap into the tech giants' networks to harness big data. And while the tech companies, they get a major traffic boost as other businesses within their companies are facing uncertainty and a slowing Chinese economy. Now, earlier this month, Alibaba warned of a drop in revenue this quarter as coronavirus hit supply chains and deliveries. Last night, China's dominant search engine, Baidu, issued weak guidance reflecting the uncertainty of the outbreak. Guys, back to you.
All right, Deirdre, thank you. Now, our next guest is working with U.S. hospitals to train people on how to better track the spread of a virus like this, saying the U.S. has the capability to make an impact using artificial intelligence, but it's just not trained properly. Dr. Anne-Marie Sastry, CEO of AIMSIGHT, joins us now. Doctor, good morning. Thanks for being with us.
Good morning. Thank you so much for having me.
So give us a sense, how can artificial intelligence help in a case like this? And are there ways that reliance on it for the wrong things or in the wrong way can actually hinder the correct response?
Let me take those one at a time. So can it help? Absolutely. AI can help in multiple ways. One is in drug discovery and in identification of antiviral agents. Two is in mining of data in hospitals to improve treatments in real time. And three is to identify clusters when public health organizations work together. The technology exists, but very, very few healthcare workers are trained in its use. And more importantly, trained in use of platforms that can make the technology applicable quickly. Can it be misused? Yes, of course. When data sets are very small or when people attempt to build things that aren't ratified, of course. Machine learning algorithms can become biased quickly. Again, a very important reason why training is so key. Additionally, this morning we see that the twin technologies, if you like, of AI and online are very important at points of crisis like this. Ken Langone said earlier, be calm, cool, and collected. I would add, be creative. When you look at drone delivery of drugs, when you look at autonomous vehicle delivery of foods, when you look at canceling of events in favor of holding them online, these technologies, it's logical to assume, will receive greater scrutiny and greater investment and influenced by moments of crisis like this.
Doctor, what would you say are some of the potential consequences when surveillance apparatus gets turned and combined with artificial intelligence to be used for public health? I mean, are there good circumstances for that? Are there potential pitfalls? Because as we watch the Chinese response, we've had some people, I don't know how well informed they are, suggest that perhaps in the early stages, China relied too much on surveillance and control and the data they had, and that might have hindered their response. So what happens when you start to use surveillance apparatus for health reasons?
This is why training and preparation and creativity are so important. At moments of crisis, it's hard to implement a system which is perfect. Using only one metric, like temperature or body temperature, or only two metrics, like body temperature and range of motion and movement of potential agents, is often insufficient. Buttressing that information with posts on social media, with clinical information that can be reasonably shared, makes the algorithms smarter and better and evolve more smartly over time. Again, these moments of crisis show where the system is strained and show where training has to occur in order to respond better the next time. One thing it's also done is move a lot of activity online. So even as governments are trying to figure out where disease vectors are moving, where the hotspots are, where the clusters are evolving, people and companies are figuring out ways downtown. My inbox this morning is full of messages from colleges and universities and K-12 schools figuring out what they're going to do if classes have to be canceled, for example. So this combination of AI and online is not only a way to control these outbreaks when they occur, but also to get better and more resilient before the next ones.
Do you expect us to see more changes in methodology like we saw from the Chinese last week? And I just wonder what you think that would do to public perception of the spread.
I think you're asking great questions. I mean, what would be logical would be to see evaluations of not only the technology, but also public policy. Americans aren't going to be as comfortable, obviously, with the methods that the Chinese government uses. And so you'll see public debates about how the technology should or can be used in America's, opt-in point of view. In the Chinese point of view, you'll see them working very hard, of course, to apply the right technologies quickly. And you'll see innovators, I think it's logical to assume, come in and propose and implement test cases of technology with the understanding that the public health panic is real. This is not going to be the last time this happens, and preparations need to be made for resilience.
Doctor, finally, a question about message discipline from governments versus message control. By the accounts that we have thus far, the virus was allowed to spread early in China because the government tried to control the message from doctors who early on were trying to alert people to the dangers of this virus. Right now in the U.S., the Trump administration argues they're trying for message discipline to coordinate through the vice president's office. Where are the lines? Where should they be drawn between discipline and control so that the people who know the most, who have the truth, are able to share it as quickly as possible versus making sure that there aren't all kinds of messages just floating around out there and confusing people?
I think that's a great question, and it's tough. On the one hand, message discipline helps prevent panics that are not productive and could even be counterproductive. On the other hand, having open flow of information helps with discovery. Keep in mind, the coronavirus outbreak was first detected by an AI. So figuring out how the public starts to use these technologies and then moving up into companies and public health organizations is really important. The reality is, with this outbreak, we have a different set of technologies available than were available with prior outbreaks like SARS and MERS. And so these governments are grappling with what is the policy going to be in light of the openness of information and the availability of new platform tools.
All right,
and I think you'll see that in the public.
Dr. Anne-Marie Sastry, keeping us grounded in the science. Thank you.
Thank you so much.
It has been a week full of huge reversals, and for that, we're going to turn to Dominic Chu. Dom, I'm just looking at chips right now, largely green. Microsoft's up. What else you got?
Oh, yeah. I mean, it's been interesting because amidst all of this, it was just about 24 hours ago that we were highlighting some of the big moves in stocks tied towards positivity around coronavirus. You may recall that Clorox was one of the stocks that we highlighted just yesterday as being a real outperformer during this whole coronavirus scare over the last week or so in markets. But look today, now down 7% as a big reversal has happened in those particular shares. Let's also check out another one. This is a drug maker, Moderna. It's being credited with having one of the experimental treatments that could attack the coronavirus at some point. Remember, those shares rallied strongly over the course of the past week and year-to-date period. But look at this today, down 10%, so another reversal there. And then Netflix, online streaming. Could they be a beneficiary if people stay at home more, don't travel as much, stream more video? It was positive over the course of the year-to-date period. And then today, you can see here, down by about 1% in trading so far today. The one standout I would say there that's still trying to hold on to some of that real upside momentum has been in Zoom Video. Those shares now, well, now they're down 7% as well. You can see earlier today, they had moved higher. But again, some of these coronavirus winners, so to speak, have now been reversing. So that's the story about some of those trades. We also want to take a look at what's happening with the energy sector overall. Take a look at the energy sector spider, the ticker XLE there. It's at a more than 10-year low at this stage, on pace for its worst week and month since October of 2008. Meanwhile, oil is continuing its slide. WTI U.S. benchmark crude down 16% this week, on pace for its worst week since December 2008. So as we talk about reversals, could we see energy and technology, the two, John, worst performing sectors on a one-week basis in the S&P? If there are bounces, could those be one of those places? We'll wait and see if that happens this afternoon. John, I'll send things back over to you.
Dom Chu, thank you. And I do just want to mention what's happening with the major indices right now. Well off the lows. The Dow now off a little less than 500 points. That's about 1.9%. The S&P off 1.5%. The NASDAQ has had the bigger recovery of all of them, off just 0.6%. All of those well off the lows of the morning. The Dow's been down more than 1,000 points at various times this morning. Now, shares of VMware lower this morning after a mixed quarter that saw the company fall short of some estimates but beat on revenue. That stock now down about 7% amid today's broader sell-off. Pat Gelsinger, CEO of VMware, joins us now exclusively on the quarter from Palo Alto. Pat, good morning.
Good morning, John. Always a pleasure to spend time with you, and thanks for the opportunity to be with you and Carl today.
Thanks, and definitely want to talk about the quarter here and what's happening with VMware. But first, I want to talk about the coronavirus, COVID-19, and the adjustments the tech industry is making. First of all, what are you doing with business travel? What impact is it having on demand that you're seeing out there in the marketplace?
Well, thank you, John. And, certainly our hearts go out to those who are being immediately impacted by the virus. We've taken a moderate view in our business. We've seen the supply side continue largely unaffected, and the interest in tech transformation remains high. The supply side, or the demand side, is doing well. The supply side, much more affected by the hardware aspects and delivery. So we're seeing more impact there. And you've seen that in places like the Apple impacts. In our business, we've moderated our activities for travel. We've eliminated some of our major events. We saw the Mobile World Congress. I was looking forward to seeing you there being eliminated. Some of our sales kickoffs we've moderated. We've also seen that many of the remote workforce aspects, and we've worked to give our employees more flexibility to work from home. We've also seen that to give us some business strength in our end-user computing business, as customers really want to have more of that workforce agility as well. well. So overall, moderation. We continue to see tech having a very powerful future, and the interest in the demand of their transformation to remain very high. And having just gotten back from Mobile World Congress on tour, as I describe it, in Northern Europe, the interest in VMware and those technologies for transformation remains extremely high in the market.
Pat, what insight can you give us into the process that VMware and companies like it might be going through in deciding what types of events or travel visits to go ahead with and which to pull back on? Even domestically, we see a number of events, Facebook's F8, for example, getting shelved, companies pulling out of events. I've heard kind of on a one-off anecdotal basis that it has to do with questions about who are the health personnel that are on site. Have the event organizers had the time to run through various scenarios and tell companies what they'll do if there's a problem. And even if there's not the expectation that there's an outbreak in the area, if the organizers can't answer those questions, well, then we're not going. What's the process you're going through?
Yeah, and we have an emergency response team who's looking at this, as every company does, and we're trying to assess how many people would be traveling from areas of greater risk. What are employee concerns as well? We want to be sensitive to their concerns and giving them more flexibility. And for instance, next week we're continuing with our U.S. sales kickoff in Las Vegas. We feel the risk of that is low, but we've eliminated the APJ and Europe events and preferring instead for a virtual kickoff that gives our employees the same benefits of kickoff, but doing it in a fully distributed fashion. So we're trying to be very sensitive. And obviously our emergency response teams are accessing all of the best known information sources around risk management on a global basis. And we try to follow the industry trends. We didn't pull out of Mobile World Congress, but we're interacting very much with GSMA to understand their plans. And when they came to that decision, we were in full support of it.
I do want to mention, as we're speaking, session highs across the board for the major indices, down just 300, it's odd to say just 318 points or so. The NASDAQ has gone positive near the flat line. Pat, I want to talk about VMware's business. Weaker than expected billings, revenue arguably ex-Pivotal. Your mix was a little bit more towards software as a service than expected. Explain what happened here and when this is going to clear up.
Yeah, and we had a mixed quarter, as you say, that finished a very strong year. Major acquisitions, we grew in the double digits. We had 15 quarters now of double-digit growth. And in the fourth quarter, we saw this acceleration in the SaaS and subscription business, something we've been working on for a while and where the puck is going in the industry. So that's exciting, but that depresses near-term revenues as those businesses grow more rapidly. We also saw an extraordinary number of late quarter deals. Some of those pushed very late in the quarter, and simply put, we didn't get them all finished at the end, which also was a factor as well. We own it. We believe we have to execute better, and we have enough demand, and we're seeing the customer interest in our products to believe and set double-digit growth guidance again for the year that we just communicated on our earnings call yesterday. And we feel like we can continue to satisfy digital transformation for our customers across our portfolio of products, and excited about what the year will present.
The end of last year, very beginning of this year, I was hearing in the cloud ecosystem from Amazon, Microsoft, Google, others, that they were hiring sales forces, really pushing strong into this year, expecting growth. Has this issue, the coronavirus, affected that at all? Or do you think the cloud momentum in terms of pursuing aggressive sales is going just as strongly as it was at the end of last year?
Yeah, our view and the view that I've said is that digital transformation is a 10-year cycle. And in it, GDP, tech spend, and software and cloud spend is even higher than that. I don't see that changing, John, in this year, even though GDP might lower that overall stack a bit. And in that, cloud hiring, the VMware activities and multi-cloud, our partnerships with Amazon, Azure, Google, IBM, Alibaba, all of these remain very strong. And we're seeing very strong demand interest from customers continuing as they see this transformational ability, because Digital transformation is not an IT budget item. It's a CEO priority, and the C-suite is focused on it. So we see that continuing really unabated into this next year, and our partnerships with all of the major cloud guys gaining momentum in the marketplace. Huge interest here.
That long-term focus we keep hearing so much about. Pat, always great to have you. Appreciate you coming over and being on with us. Good quarters, mixed quarters, and everything in between. Good to see you.
Thank you, John.
John mentioned the turnaround a few moments ago. Dow is 500 points off the lows. NASDAQ's gone green. Microsoft's green. Apple, the chips. Clorox, which, as you know, has been a huge winner this week. Jim Cramer recommended selling it this morning. It's down 6%. VIX has gone from 49 to 43. And comes on the heels of Goldman saying they see 75 basis points of cuts in the first half, no outright recession around the world, and a short-lived global economic contraction. So we'll see if this holds. We did get similar action yesterday as well. Let's get the Santelli Exchange at the CME. Hey, Rick.
Hey, good morning. You know, there's one word that I hear from traders, especially the younger ones. Some of us older guys have seen some of these big days or weeks like 1987 or Thai baht crisis, but the word was ferocious. And I like this word. It describes the market and it gives me a way to summarize the week. F, of course, has got to be for the Fed and all the talk we are hearing. Listen, 50, 75 basis points. Obviously, this piece is my opinion. It's the Santelli Exchange, and I think it's crazy talk. I think right now, the Fed doing anything, any central bank doing anything would be wasting moves into a strong gale force wind. And he has to be for equities because this is the place we're all hanging out. Why? Because the Fed put us all there. That's why they have this parental feeling to monitor it and make it such a potentially large signal in terms of obviously, it's rates. And rates, I've never seen anything like it. I've been looking at interest rates since 1979. This has been a breathtaking move. It's hard to use technicals because especially the long end is at extreme ranges. I know the golden mean has an expansion of 1.6, and we can look at a variety of different patterns that can give us glimpses of where an extreme new low yield or high price stops. But boy, that's way more art than science. Over the skis, you know, this one I like. How many times have we talked before the coronavirus that many thought we were getting over our skis, but it really didn't matter because it certainly seemed as though the low rate environment was okay. It did take an exogenous shock like coronavirus. Finally, the credit markets, I really like this one. I'll tell you why. Organizations that are trying to help guide the globe through this, they all have their heart in the right place. But at the end of the day, how many people in Washington, how many people out there put huge confidence in organizations like the UN? Listen, when things like cat bonds, WHO has a vested interest because whether they get paid out or not on some of those is determined why it's labeled an epidemic or a pandemic. So they may have some dogs in the hunt. Finally, unable to price. This is a big one. What does unable to price mean? That means that this coronavirus is beyond the markets. What we are seeing here is not pricing in corona. It's pricing out uncertainty. That's what it's doing. And finally, safety. Is there any bigger word than safety on ferocious? And I'll tell you what, moving into safe harbors, whether it's the yen or whether it's interest rates, is going to have a digital outcome. It's going to have a V bottom because there will be a point in time where safety is no longer required and the pricing of those investments will not make sense. John Ford, back to you.
Rick Santelli, thank you. And as we head to break, quite a bit of action for all the major indices this morning. We are off the lows. The NASDAQ was briefly positive, but that attempt at a rally is now being tested on all the major averages over the past 10 minutes. Sellers have kicked back in. Let's take a look at the biggest NASDAQ gainers now. NVIDIA, Xilinx, among them Qualcomm, Booking Holdings, and Micron. Squawk Alley. Be right back.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app to see the latest editions under the Your New Episode section. Happy listening.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Uses powered suction to flush out allergens, germs, mucus, and dirt.
My doctor recommends Navage to breathe better through my nose, and it works. Congestion's gone, and I feel great.
And Navage is so much easier than a neti pot.
Trusted by happy noses everywhere, Navage is nature's decongestant. Online and at these fine retailers.
How's the IT department liking the Now platform?
Every time it takes care of something for us, we celebrate.
How often does... Got it.
ServiceNow, the smarter way to workflow.
Read yourself past the millions and millions of stories uploaded each day, past the endless memes, past all the social media that's making your head feel like. Read yourself better. She worked with Travis Bass, Ricky Williams, that's Hilliard, Dennis Rodman.
Pro sports superfan scams athletes to score millions. All new American Greed, Monday, 10 Eastern, CNBC. Get yours.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
Is your credit card debt stressing you out? Take control. A personal loan could help you get out of debt faster and save money. Credible helps you find actual pre-qualified rates from multiple lenders in just 3 minutes.
Visit Credible.com to see how much you could save.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school. Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
For schools, options include dividing students into smaller groups, or in a severe pandemic, closing schools and using internet-based teleschooling to continue education.
That was the director of the CDC's National Center for Immunization and Respiratory Diseases, Nancy Messonnier, citing the need for more remote work capabilities due to the rapid spread of the coronavirus. Our next guest heads a company that provides such a service. Citrix CEO David Henshall joins us today from Florida. David, thanks for your time today.
Thank you very much.
I don't want to set you up too much to toot your own horn, but I do want to ask you whether you think at large we're at a bit of a turning point when it comes to either learning or working remotely.
Well, I think if I step back and I think about Citrix, we've spent the last 30 years focused on connecting people and information and doing that on demand. And we're fortunate enough now to work with roughly 100,000 enterprise customers around the world in every single geography and every market, really talking about how we can make people more productive, more engaged, and as a byproduct of that, just give them a lot more flexibility into the way work is changing. Because we've long espoused this idea that work is not a place, but it's a thing you do. And giving people the right digital tools to be productive on their terms, frankly, they can just accomplish some amazing things.
Do want to give people a check on the markets while we're talking. The Dow now back down more than 700 points, nearly 3%. The S&P and NASDAQ following suit. NASDAQ back in the red. David, we've seen that Zoom, which had a recent IPO, does video conferencing, has gotten a lot of orders. The stock has actually performed pretty well as people realize the need to work remotely. But I wonder how much of that is actual new usage that's going to continue, and how much of that is companies hedging and saying, hey, if something gets bad, we need to have this tool in our back pocket. Is the reaction here kind of a back pocket tool, or is there real usage that's going to increase, you think?
Well, I think collaboration tools, and whether you're talking about Zoom or GoToMeeting or many others, it's a part of the overall story. If you step back and you think about the environment that most of our customers are operating in, the typical Citrix customer has about 500 applications in their infrastructure, and those are the things that run their business on a day-to-day basis. And so giving their teams the ability to access those things on a regular basis that is secure, that is highly managed, that is available anytime, anywhere, that's really the complete picture that we talk to customers about. Because video collaboration or email or
some of the productivity solutions, it's really just a part of the overall set of challenges that they're facing. Really need to step back and take a much more holistic view of their overall infrastructure, not just in the scenario of business continuity, but really where work is going and the trends that we're seeing across demographics and ability to tap into new workforces.
So for all the investors who've obviously been hurt by the decline in shares of travel-related companies this week, what is the role of travel in American business from here on out?
Well, I think travel right now is somewhat of a temporary phenomenon that's being impacted. We're all still going to travel and collaborate in a lot of different ways. I mean, if you step back and you look at Citrix as an example, we basically build the solutions to allow our teams to be mobile. Everybody is effectively a mobile worker, and we typically have only between 25 and 50% of our teams in any office at one point in time, because they're out with customers, they're working from non-traditional locations. Everybody is effectively a remote worker. And so giving them the tools to enable them to do that is really, really critical. Never going to replace the ability to work face-to-face with a customer, a business partner, an employee, but there needs to be the level of infrastructure to be able to support all of these alternative work styles, whether we're talking about a current situation like the coronavirus or just much more broadly, the fact that we live in an environment that has a lot of disruption.
Yeah. David, thank you. Good stuff. David Henschel of Citrix this morning. So we're going to watch the afternoon session. Next week, we're going to get a jobs number, PMI. We'll look for the South Carolina primary over the weekend and see how the race is shaping up. Let's get to the judge in the half.
I'm Scott Wapner. The fastest correction the stock market has ever seen, getting a little bit deeper. Welcome to the Halftime Report, where we are focused on your money as always. The investment committee is here with me as usual. Stephanie Link, John Najarian, Shannon Sakosha is the Chief Investment Officer at Boston Private Wealth. Brenda Vingello is the CIO of Sandhill Global Advisors. Rob Sechin of UBS Private Wealth Management is one of Forbes' top 100 financial advisors. Dan Greenhouse is back. He's Chief Economist and Strategist at Solus Alternative Asset Management. Our senior economics reporter alongside us today, too, Steve Leisman, of course, helping us make sense of everything going on and where the Fed is thinking about all of this. The worst week for stocks since the financial crisis. That's what this has been. The VIX surging today, bond yields falling to even new lows. Stephanie Link, you know, a minute ago, the NASDAQ was positive. The NASDAQ went from positive to down 1.5% again in about 10 minutes, if that. What does that tell you about sort of where we are? Is that how a bottoming process happens? Do you think we're close?
I hope so. I mean, I think people are very confused, obviously, right? It's not surprising that the market went down because of this, because the virus has gotten so expanded. The surprise has been the speed of the decline. To lose $6 trillion in market cap in 6 days, that's remarkable. So I don't know when we're going to bottom, but I'm looking at an RSI at the S&P at 20, the VIX. And John, you could talk a little bit more about that. But a VIX at 47, to me, it seems a bit extreme. And then I look at what happened in the Shanghai index. It fell 14% at the beginning of the year, and then it bounced on February 3rd. It's up 14% and 2% off its high. So that could happen to us. I don't know what the catalyst would be. Maybe it's a global central bank coordinated effort. That's the rumor, and I think that's why we're bouncing around a bit today. But I've been, as you know, slowly buying. I've been wrong. But when I have Coke going from 60 to 50, when I have Nike going 104 to 85, Twitter 38 to 31, I mean, these to me are opportunities if you have a long-term view.
Have you been adding some to those?
All three of those.
Today?
Yeah, yesterday.
Okay, so in the same wheelhouse of what we're going through. You want to touch, Doc, on this VIX? You know, I asked your brother the other day what was the number to suggest maximum pain. I asked if it was 50.
Right.
We got to 49.
Well, you were prescient as usual.
You said 38, but I mean, you needed to see something more elevated than where we were.
You did.
What does it tell you that we hit 49?
Yeah, 49, 48 or something like that. So $49.50, let's call it. That was a huge spike. It happened in the pre-market. We got to 47. During the regular session, as you say, we got to 49.50 or thereabouts. And one thing that really stood out to us, Scott, both in terms of the VIX and in terms of, to Stephanie's point, a lot of the stocks that she talked about, as well as the indexes, we had just been seeing selling and volumes accelerating on any rally. People were selling rallies. Now, actually, on dips, we're seeing likewise volume surge on our computers. We're seeing volume surge, like, for instance, the QQQs this morning, which is the NASDAQ.
Which went positive,
right?
By the way, and the semis
and it
acting pretty well today, too.
Surged on volume, like 5-6 times normal volume. Popped that thing up from the lows of the day, which was right around, let's say, 199 for the triple Qs. Drove it all the way back up to about 207. And then, once again, volume surged, and this time it was selling pressure. So we'd seen the selling pressure for 6 straight days. Every rally was sold, right? Now, today is the first time after that big pop in the VIX when we're seeing buying or volumes increase also on the dip, not just up at the top. So that's a good sign that we're finally starting to get. I'm not saying it's over, Scott, sure. But to your point and Pete's point, we needed to get to that cathartic sort of flush, and a VIX at 49.50 certainly feels a lot closer.
Why don't we go to this Fed notion that Steph mentioned, this market, maybe you use the word hoping is the best word to use for this coordinated effort of some kind, whether it's a statement or otherwise. It's Kevin Warsh talking about that on Squawk this morning. There's Bullard making some comments today. The market's looking for a 100% move by March. What do you think is going to happen this weekend, if anything?
I think it's possible something's going to happen. My suspicion here is that the Federal Reserve is looking for some creative responses to this. I think my best guess is they have internalized this idea that the rate cut has a very limited effect in this environment. And so my guess is that they're thinking about alternative responses here that might mirror some of the alternative responses from the global financial crisis. For example, when there's a hurricane, Scott, the Federal Reserve, there's actually an interagency memo that goes out where they urge banks to give relief to borrowers, and in the case of difficulty of repaying. I think the Fed can make a statement that it is ready to provide liquidity and ready to cut rates. But before I do that, this is now on the screen here. What's been coming out of the Fed has been the opposite of this. They have very much held the line, and really Bullard sort of ups the ante today when he says rate cuts are a possibility if a global pandemic actually develops. And then move to the right. Evans also said it's premature. And there's this comment from Bullard, which I think the market sold off a little bit before he decided to sell off some more on some other things that were out there. But now look at those three statements, and then let's go to the probability charts. It's not a hope. It's a definitive. We're sure this is going to happen. 100% probability on a rate cut with a 53 or 54% probability of a 50 basis point cut.
Hey, Goldman, just before we came on the air, there were some new headlines moving from Goldman's expectations. They say their baseline now is they see the Fed cutting 75 basis points in the first half.
Okay.
So that's,
there's 4 rate cuts built into
that's
the
offsides with
and
what you just had
so,
on the wall there.
The reason I asked before the show started what time futures open on Sunday, which is I think if we open to the downside in a serious way at 6 o'clock on Sunday night, I think either because of that or even if that's not the case, you could have some statement from global central banks and certainly an interagency statement. I think it's too long now for the Fed leadership, not just Evans, Bullard, and to have been quiet. And my guess is Powell is sitting there working with, some very good people they have on the Fed, trying to design some creative responses.
Is there a chance that Powell would want to do something, make some kind of a statement during market hours today? Or is it more likely to wait, digest things a little bit on the weekend, see how futures look, and then do something?
I don't think so, Scott. I'll tell you, it was Warsh this morning who he's been there in the crisis before, and he said they want to get to the weekend. They want to get to the weekend, and they'd like to make this decision in the absence of this strong downdraft out there. Although you remember, and you guys are old enough to be there, maybe not everybody on my left here, the women, of course, but when all it took was Greenspan in 1987 to say, we're there to provide liquidity.
That's it.
That was a big deal. That was a big deal. He didn't have to do anything.
I couldn't agree more. You need a plan of action, not action. And so far, there's been a vacuum of information. I don't care if that's monetary policy, fiscal policy. I actually think there's some risk of action too early when it's not supported by the economic data. So, I just think that if you start to treat a patient that's not critically sick yet, just because the markets are pressuring you into doing that, everybody's saying the Fed's behind the curve.
The patient may be totally happy with an ice cream cone rather than
correct
the actual medication.
That's right? Exactly right.
It makes you feel better.
That's exactly right. And I think there's a number of catalyzers. One's progression in containment, right? You get some progression in containment. There could be a valuation catalyzer here at any point. And technically, markets are oversold. You know, Scott, I talked to Lee Cooperman before coming on the show today, and he spent a lot of time on the structure of the market. This is not necessarily fundamentally based. It's headline based. It's the elimination of the uptick rule, and you've kind of got this downward momentum being sold. And I think that's a really bad thing. And when you have fear gripping the market like we have today, anytime somebody's fearful, public speaking, anything like that, they are not going to make decisions rationally. And I think we have to make rational decisions now.
Let's try and make some rational decisions.
Scott, can I just time in very quickly with a simple point, which is important to the Fed, which is the market has cleared to the downside. There has not been disruption in the market, which is the kind of thing that would bring the Fed in for sure. But as we've gone down, nobody's happy about that it's gone down, but you have to be at least somewhat, what's the right word, becalmed by the idea that it's gone down in an orderly way without disruption.
I got to interrupt. I'm sorry to interrupt. Please go in 1 second. I take total issue with the idea that this has been orderly. This is 3% a day for 5 days. I'm sitting on the desk watching the screens, and the only word that you can use for this, I would argue, is crash. Whether it's justified or not, or warranted or not aside, the market is effectively crashing. And so I would take issue with the characterization.
It's different, Dan, though, than the idea that you cannot buy or sell a security. That's what I'm talking about. That was when you had real plaque in the arteries of the financial system, and the Fed had to step in to provide liquidity to those markets. I'm not saying this is not serious. I'm just saying in the way it has happened, it is in a way that does not engender fear of so far of the market.
When the patient was very sick, right? Patient was very sick. We have essentially a healthy patient. So in 08, when we saw this same type of price action, I think it was justified. You said whether justified or not, Dan. I agree. We are having major price moves, completely fear-based. And I think if we have a catalyzer, it's going to be a totally different situation than 08. You don't have the same forced selling that you do in 08, which is, I think, your point, Steve. You're not going to have banks being forced to sell
What I really want to know, and I think people are trying to figure out, and that's from the biggest of the big investors that I've been speaking to the smallest of the small who I'm thinking about, whether you should feel comfortable enough yet to buy, Shannon, the dip, so to speak, right? Goldman today says it's too early to add risk tactically. There's a lot of commentary out today. Barclays says it's too early as well. Morgan Stanley's Mike Wilson says we're sellers of rallies, which seems to be some of the action you've seen in the market. As I said when we started, that real rip in the NASDAQ to get it positive was sold immediately. I mean, it barely lasted longer than I've been speaking now. What do you think we should be thinking about telling people? What are you thinking yourself?
I think you have to consider why we're selling and why the uncertainty is different than, say, the financial crisis or what we're facing now. The uncertainty is that we have something that we cannot anchor to a particular situation. And so that creates a lot of difficulty when you're thinking about your overall asset allocation and you're thinking about whether it's time to add risk or decrease your risk to the overall portfolio. If your expectation is that we were going to continue to garner the gains that we had last year into this year, then it's difficult to add here. If your expectation was that we were going to have muted global growth and that we could potentially have some strength in the back half of the year based on a reacceleration of manufacturing, then there's still an opportunity here to add to stocks. Again, you think about the alternative. If you didn't like the 10-year at 155, you certainly don't like it at 117. And you're not earning any money. And so if you think about it in just a short, whether it's a short-term perspective or a longer-term perspective, if you need to have money that's garnered from your portfolio, you're not getting it in bonds. And so for me, I feel comfortable adding to stocks here. I think that based on our expectations for the next 5 to 10 years, we believe that stocks will continue to move higher. Our view is that this is probably overstated. I went on a show last week and said that I thought that a Fed cut would be an overreaction. I certainly think 2 or 3 would be an overreaction. And so I believe that you can add to risk here thoughtfully, and that's how we've done it. I think, you really need to think about where you're adding.
What does thoughtfully mean? Like, to where? Where have you added?
I think we've taken some of our more cyclical names. We've realized that the rotation to value that we were anticipating would perhaps be later in the year, if not happen at all. So we've taken some of our more cyclical names. We've gone back and concentrated our positions in higher quality, good cash flow, good balance sheet, higher dividend paying names. I think that is, the right way to do it. Stephanie was talking before we came on about some of the names that, have pulled back. And there are great companies that are going to be insulated, that are going to continue to grow their business outside of GDP growth that you can add to your portfolio.
With good balance sheets and dividends that are strong
and sustainable
and safe. And that's it's not tied to a commodity. You can't look at the energy stocks at this point for yield, although I do own a few of them because they've gotten just hammered. But I think if you're looking at some of these higher quality companies, these blue chip names that are starting to yield 3.5%, 4%, I mean, it's almost a no-brainer to me to be picking away at those kinds of names.
That's kind of Kramer's perspective, too.
I agree.
Some of these things he didn't use the words no-brainer like you did, but the message was almost the same, that some stocks have gotten decimated to the point, if you have some cash to put to work, that you've got to put some to work. I'm paraphrasing what he said, but I think the spirit of what he was saying
and it's
is
not
that.
just Coke and
Easy
P&G,
for me to say,
right? It's not just Coke and P&G, although both of those have come down quite substantially and they're more attractive now. But it's like a Cisco, it's like a Caterpillar. I mean, it's some of the cyclicals. I get it. I totally understand why you're reducing your exposure there. But I would say that some of these stocks have just not only have they gotten hit on valuation, but they're also now yielding 3.5%, 4%. That's really pretty attractive.
I gave you, some of the calls that are out there of, the Goldmans don't buy the dip, don't add to risk yet from another firm. But there is there is another side of this too that says we're going to get a V-shaped bounce. That's Tom Lee's word today. Doesn't say when exactly the bottom is, but they believe a V-shaped bounce is coming.
I think that we can all pontificate about what we might think would happen, and nobody knows exactly what's going to happen. But I think if you have a long-term view, and, as Shannon was saying, if you look at where bonds are today, for people that have a diversified allocation, you look, what do you think is going to work over the next 12 months? Is it going to be stocks versus bonds if you're putting $1 to work today? And our view would be that it's likely to be stocks that outperform bonds over that period, assuming that this overall panic subsides. And I don't know if it's really going to be Fed action that causes it. I think it's going to be probably an announcement from the World Health Organization calling this officially a pandemic, and you get kind of a max fear moment, and maybe that's the moment where a line in the sand is drawn and we start to get some more constructive buying going on.
Serious question. Has anyone come on your show and said over the next 12 months we think bonds will outperform stocks?
Right now.
Ever. I don't mean that. If that came out derogatorily, I didn't mean it that way. I just
but it's happened.
It has. I don't watch every day. I apologize.
Let me ask you this: we're talking like orderly, disorderly, other things that we're watching closely to see if things are sort of spreading outside of the norm. High yield is a place that people are watching. I know you are. You've been talking about it already on the air. Bank of America is certainly thinking about it today. You've had the third largest outflows ever this week out of high yield. They say the risk of a credit event is, in their words, surging. Maybe that's overdoing it a little bit. I don't know. But there is activity taking place in high yield that's making some at least nervous.
Your eye is on the right ball there. That's the thing that changes the dynamic here. And this is one of those situations where the tide is rapidly going out, and we're going to see, for lack of a better metaphor, who's got a swimsuit on, who doesn't. And we know we've been living in a very low rate environment, and it's something that the market has learned to rely upon in such a way that perhaps some of the lending criteria out there was not as strong as it might have been. And perhaps banks begin to be concerned about these things. I don't want to be the one to start this thing before it's out there, but the fact that Bank of America is looking at it,
it's out there.
the fact that we're thinking about it, and I have to just question the panel a little bit on this, Scott, in that underlying all the talk is that somehow this all goes back to normal. And I'm trying to think of a person who's 75 years old that's been running a portfolio like a 35-year-old because they've been allowed to for the lack of risk that's been out there. They look at this now and they say, wait a second, a 10% move in 3 days means I really cannot get out of the way of this. My portfolio is, for lack of a better term, misshapen for my age. And I just wonder if, this is a Humpty Dumpty case where maybe you can't put all of this back together again. There are times, and I don't...
entirely a bad thing,
let me just finish the thought real quick, which is there are times that come along when there's a trend, and perhaps the trend is lower rates or whatever it is, and the shock comes along and it accelerates your move to that moment.
That's a great... Louis Bacon used to say that oftentimes when you're a trader, something comes along and knocks us into a different atmosphere, meaning it's totally changed the game. 2008 being an example of how people think, how people allocate. I do not think this is that event. I just cannot see that playing out. When somebody's sick, they get a kidney stone, they go into the hospital, they're a relatively healthy person, they get addressed, they come out, they resume normal activity. If they have a really bad case of it, they stay in the hospital for a very long time, their muscles atrophy, and you have significant damage that's sustainable. I think there's something about the pace of this transition, and whatever the catalyst may be, hopefully it's a progression towards containment in the markets that it started, and you can start to see that play out in other markets. But if it's not, there's going to be other possible catalyzers, whether it's the Fed providing liquidity, not cutting rates. To me, that I don't know. You're pushing on a string there in some regard, or it's some fiscal policy response or effort that is at least talked about.
So let me do this. Mike Santoli is at the Stock Exchange again for us today, listening to all of this. I know you have opinions on what you've heard. What stands out the most?
I guess, first of all, on the whole question of is it time, are we oversold enough, I do think it's always smart to kind of excuse yourself from the idea that you're going to catch it right, and essentially assume that this kind of movement, these highly stressed markets that are going to be spring-loaded in their moves, they're going to make almost everybody on every side feel stupid periodically as you go along. So if you kind of give yourself permission kind of not to try and get every wiggle right, that helps. I think everything you look at, if you want to go down the checklist of are we washed out enough? Have we administered enough pain in a short period of time? Have we gotten enough of the concentrated unwinding of overcommitted positions by professional investors out of the way? I think it says yes coming into today, but we overshoot all the time. I don't know that the time element is something that we can yet say is our friend, simply because I think we have to stress test the market for the headlines everyone knows is coming. Right? We kind of know we're going to see more about the spread of the disease, about corporate responses to it, about economic restrictions, all the rest of it. So that'll tell us if the market is discounted enough in a short period of time. The history of buying super washed out markets with a multi-month or multi-year time frame going ahead tends to be pretty favorable, but with feeling stupid along the way, because it doesn't happen in an instant. It does not happen as a moment. It happens as a painful process. So all those things are in the mix right now. Right. I mean, today you can look at some areas that were leading us into this situation and got really bombed out that are trying to rally, but that could simply just mean everybody who got it right is just taking some money off the table. So it's very difficult to extrapolate.
It's so difficult because there's so many unknowns. You can't determine what price stocks should be trading at if you have no idea where earnings are going to be impacted by all of this.
Well, hold on that
for
a
Goldman's
second.
talking this week about no earnings growth. That's not how we came into the year. Stocks were not priced for that scenario, and they may not be priced yet appropriately for that either.
But with idiosyncratic events like this, at some point in time, you pivot beyond them and you start to think about 2021 earnings. And when you do, there's no question if the S&P can recover in some V-shaped form, 2021's earnings are going to be higher, and we are trading at a much lower multiple than we just were a little bit ago.
Yeah, but if I can tie that into what Mike and Sarah earlier today were talking about, something that's really relevant with respect to what Rob just said, which is this assumed V-shaped rebound. And I want to be crystal clear. I am making no political comment right now whatsoever, except to accept the market's assumption that a Bernie Sanders presidency is worse for the market than a Donald Trump presidency. And if we accept what the market says, not what I'm saying, then the V-shaped rebound out of this comes right into the Democratic convention, where you're nominating someone who the market believes is not as friendly. And as you turn your attention to forward earnings, you have to incorporate a different environment.
The probability of Bernie being...
So if you believe that the virus reduces the odds of a Trump re-election and increases the odds of a Bernie election, again, not a case I'm making, but I'm saying, then you have to reassess how you view earnings over not just the next 4 quarters, but the next 8, 12, and thereafter.
You don't have to qualify it like 10 more times. We get it, all right? You're not making a political statement in any way, shape, or form. So I save you and everybody else, frankly.
Scott, could I hit Steve just on one thing? Steve, you remember, and I'm older than you.
Really don't want you hitting me, but that's okay.
No one wants John.
Fist bump.
Pretty good at running and ducking, but
it used to be that we'd always say you should have the percentage of your assets in fixed income like strategies, bonds, and so forth that match your age. So in other words, that 75-year-old money manager you're talking about would have 75% of his or her assets in bonds, which would be a 14% positive on the year, more than offsetting the 12% or 14% decline on the 25% of their portfolio. So all I'm pointing out, I'm not saying everybody should go out and rebalance and do that, but if you are in assets that all go the same direction, so you're in EFA, you're in EEM, you're in, the U.S. and so forth. When you have something like this that's hitting stock markets around the world, it really shows that you're overweighted in those equities.
Everybody at this table, at this table can hang their head high, because I happen to know everybody at this table, having told people you've got to rebalance when the market surges. You have to have a mix of assets, and you can't be reckless relative to your age. There's nobody at this table who hasn't said that at least
and
once
I wasn't
on this,
saying that you
on
were,
this show.
How much do we need if the stocks like the Microsofts and the Apples and the Amazons, if they led you on the way up, and now those kinds of stocks have gotten decimated, $1 trillion lost in 7 days from the most marquee of names in the market right now, and certainly where a lot of the focus has been in big cap technology. You need these, Steph, to rally back to let you know that it's okay to take the market back. If they led you up before and they've gotten hammered now, do they have to lead again?
Well, it sure will help being 26% of the S&P 500 weighting,
like
right?
Industrials are not going to lead you back, right? I mean, it's got to come from here.
No, I mean, this is the biggest weighting. So they should. But here's the problem. Microsoft is still up 1% on the year. NVIDIA is still up 12% on the year. Most of these stocks are still, maybe they're flirting down 2, 3, 4%, but nowhere near what the energy stocks are doing, or the industrials are doing, or the financials, or even some of the consumer discretionary. So I would argue, yeah, you do need tech to certainly support, but maybe you also need consumer stocks to support, because you're right, industrials, energy, and financials collectively are just not that big.
I was going to follow up with a question to you, as you were just describing, well, the stock is still up on the year, whether that's a tough sign in and of itself that it needs to come down even more.
Exactly right. Technology, I think, in general, has to come down more. And the only technology's name I'm buying is already down a lot, 12%, and that's the Cisco that I was talking about.
Okay, so then the biggest sector of the market hasn't finished correcting yet. $1 trillion lost in 7 days could get worse. The market can't bottom until those stocks are done going down, right? I mean, seems logical. How can you have a bottom if those big cap stocks, the biggest cap ones, are going down in the biggest group in the S&P?
Because, Scott, the human race will get over this. We know a couple things.
No, I'm not saying the market can never bottom.
No.
This is not the plague. This is not this. But I want to answer your question. It's not the plague. We're pretty sure it's not the Spanish flu yet. We lived and markets prospered in this country when polio was much more rampant, when smallpox was much more rampant. We have the ever-present flu. I think the question to ask, and I would love Stephanie's answer to this, is when all this is done and when we have learned to live with this virus as part of the human existence, will I be happy having bought stocks right here?
Absolutely.
Yes.
Absolutely not a question in my mind. Not a question in my mind.
So I can buy stocks here. I can go to the Bahamas to what I want to create, which is a corona-free zone right there.
You know what you could do right now is you could upgrade your portfolio. You could buy blue chip quality names that are down 10, 15, 20%.
When this is all done,
diversify out in a variety of
will
different
I have
sectors,
been happy?
and you will be very happy.
Jen.
The opportunity, I understand Microsoft is not down for the year, but it's down a lot from where it was a few weeks ago. And there are people, you saw major inflows into bond funds over the last 2 quarters. You saw people that still had cash on the sidelines who are looking for some of these names that they feel comfortable with, that they feel are longer term, what we call quality growth companies. There are going to be buyers for these stocks over the next few days.
Some buyers today in Microsoft because it's green.
I think
and
that's
you are getting a little more green out of the S&P 500 heat map. Which we're showing you right now, although it's still a near 2% decline for the S&P. So I'm not trying to make it feel or sound any better than it is, but at least you got something.
I want to make a point on technology needing to be there for us to come out. If you remember back in 2008, financials were an incredibly large percentage of the S&P 500, and the same questions were being asked. Do we need financials to lead the market out? And the answer ended up being, no, you don't. The market broadened out. There were different catalysts, and we went on a really big run, and financials didn't participate a lot of the way. So I don't know.
Did financials have as much money?
Yeah, as a percentage of the S&P. Yeah,
it's not as big as tech.
But
not now. But back then it was. Back then it was 35%.
But also the assumption was that the financial sector was essentially not going to be the same after the crisis as it is now. I don't think there's any of us who are saying coronavirus is going to change the prospects for technology and the integration of technology throughout every other sector and part of business. So I think I understand.
My point was you don't need it. You can have a broadening out of the market. It can be something different that ends up leading the way. In my
like what?
Communication services. That could be a great.
That's not that big either.
I feel like that's basically tech.
We did have our.
It sound like you were going to say, well, it's industrials or whatever.
No,
but
I'm not.
You're trying to be too cute. You're trying to be too cute with that. Some of the stocks that would be considered tech stocks have moved into the new consumer.
I get it, but they have different catalyzers.
Our CFO survey that we did in the last 24 hours showed 62% of the 30 CFOs we interview are increasing the ability of employees to work from home.
So there you go.
So that is something that's going to be out there. The kind of change, acceleration towards trend that this event might occur.
So can I just ask you a question about CapEx? Are we just going to write it off for 2020?
Stephanie, you're so smart. You're able to answer these questions without me answering them. You put yourself.
I'm hoping you're going to give me a good answer.
You put yourself in the C-suite and say, is now the time to break ground?
Not now. I'm saying in the second half of the year.
Well, okay, second half, it's possible.
Assuming
and I think
virus gets controlled.
I think what you need is clarity. And I think
doubt it.
I'll just add this. I doubt it.
Yeah,
I don't think the company CEOs. I don't think the company CEOs have any more visibility on the outlook than we have right here. Right? I don't think they can sit there and say, you know what? 6 months from now, my business is going to be X. And that's a big part of the way the market is trading. If Microsoft could come forward and say, you know what, here's what we see, and we're pretty sure that our order book tells us that 6 months from now, we're going to be reaccelerating. But they can't say that now, I don't think.
You also have to contend with the fact that this year's expectations may have just been punked big time.
Yeah.
Because of the expected front load of the gains that you could potentially get this year, which a lot of people had talked about. You front load the year before it gets messy with the election cycle. Now you've just wiped out, 13% of your market. So did you just blow your opportunity to have a nice part of the year?
This is an atrocious week in the market, obviously. But just to be clear, most of it is the multiple. It's not earnings, which raises two potential outcomes. One is that there's still further downside to come when we start haircutting earnings, because you've had about a 2.5 turn multiple contraction in the S&P, give or take, if you hold earnings flat. But the other side of this is that a 2.5 times contraction in the multiple is a fairly large contraction in the market multiple, and it's something we're seeing over in high yield and distress where Solis lives. The widening out it's not the greatest widening out we've ever seen, or the widest widening out, but it's pretty darn bad.
So when I mentioned that earlier, the high yield, what's happening, the outflows, some of the spreads, blowing out a bit, it raises the risk of defaults. And look, there have been a lot of people who have been warning about leverage, corporate leverage, too much debt, and wondering what the catalyst would be to sort of tip it over. now you have some people opining that, well, maybe this is one of those things that you could never forecast.
So let me just take 30 seconds and paint the backdrop, which is when you think about the Fed being super accommodative, the desk and our viewers traditionally will view it through the market multiple. Well, the Fed's accommodative. We can pay 20 instead of 19 or 20 instead of 18 times earnings. In the credit market, one of the ways that it has manifested itself is in significantly tighter spreads, but also a deterioration in the quality of loan documents, where companies are able to borrow money from the market and effectively promise never to pay it back. I'm oversimplifying it, but it's particularly deleterious, the language. So you have created an environment where tons of companies can get financing on super accommodative terms when they shouldn't. And they're also hiding their leverage metrics, which is another long story which we won't get into now. The combination of which provides a lot of tinder for that lower end of the credit market.
Dan, you're talking yourself into an interesting place, which is if you're the Fed chairman, is what you want to do to make that worse? Let's just
cut rates again.
Let's cut rates so they can put out more loans out there with lousy coverage.
Which is why maybe just words.
I don't know if you meant to go there, but
no, I was going to say the Fed. First of all, the Fed should not care at all about the companies that I'm talking about. This is not Microsoft. This is not Apple. These are insignificantly smaller companies in relation to the overall economy that should not be on their radar whatsoever.
I'm gonna take a quick break. Thank you for being here, Dan Greenhouse. Been good having you.
My pleasure.
Mike Santoli, I didn't get a chance to thank you, but I'm grateful for your time yet again. I have a report in my hand from Mike Mayo, by the way, the big banking analyst, talking about taking down some numbers. You want to hear this? We'll do it next.
Big banks getting better. Veteran analyst Mike Mayo's cutting targets. Our desk owns some of the stocks. We'll debate it next. And keep sending us your questions amid the market turmoil. We'll get to them straight ahead in Ask Halftime. To reach us, go to cnbc.com/halftime or tweet us. The Halftime Report with Scott Wapner and the Traders is back in 2 minutes.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
In a changing environment, consistency keeps us on track. Columbia Threadneedle Investments.
We were at historic highs 1 week ago.
The dash for safety is on in global markets. There are some very telling names bucking the trend today and rallying despite the sell-off.
How much of this correction is driven by the uncertainty, and how much of this market has been looking for an excuse to pull back?
Session lows went down 900, down 1,000, and then down more than 1,100 points.
It's essentially reversing any expectation for earnings growth. It's the fastest the S&P has ever given up 4 months of gains.
Watch or listen to CNBC live on the app.
Does hair loss run in your family? Are you losing your hair?
You can now treat hair loss at home in just 6 minutes a day with a laser light therapy that's been clinically proven to treat hair loss and regrow thicker, healthier hair. It's called the Capillus Laser Cap.
Laser therapy is an FDA-cleared treatment for hair loss. What laser therapy does, it reboots that blood supply. It reestablishes blood flow, oxygenation. It's a very effective treatment for hair loss.
Using the cap is very simple. I sit pretty much right here, watch TV, and I have it on. It is completely comfortable. You forget you have it on.
I just put it on when I watch the TV, and I got my hair back.
I feel like it truly has changed the way I see myself.
If you notice it, do something about it. Don't wait, because the longer you wait, the worse it can get.
Get the results you want or get your money back. Payment plans are available.
Call 1-888-474-0056 today or go to trycapillus.com.
Welcome back, everyone. I'm Sue Herrera. Here's your CNBC News update at this hour. Secretary of State Mike Pompeo sharply criticizing Syrian government-led attacks in the country's Idlib province, saying there is, quote, an enormous Iranian problem inside Syria, end quote.
These attacks that are Syrian regime-led, Iranian-supported, Hezbollah-supported, underwritten by Iran, along with the Russians, are now causing a humanitarian calamity in Syria.
Some tourists are starting to leave a quarantine hotel in Spain's Canary Islands. About 130 guests getting the go-ahead to check out. The remaining 600 vacationers at that hotel are to stay under lockdown for a total of 14 days after being exposed to the coronavirus. Many heavy smokers are not getting screened for lung cancer. CDC researchers looked at data from 10 states and found over 87% of the people who met the criteria for a lung exam had not gotten a CT scan in the last 12 months. Lung cancer is now the leading cause of death in the United States. You are up to date. That's the news update this hour. Scott, back to you.
All right. We appreciate that. Thank you, Sue. Now to Phil LeBeau, who has a news alert on General Motors. Phil?
Scott, GM is going to be hiring 1,200 workers this spring as they ramp up production at two plants in Lansing, Michigan, adding 400 workers at the Grand River plant for the new Cadillac CT4 and CT5. And then at the Delta Township plant, they're adding 800 workers and a third shift so they can increase production of the Chevy Traverse as well as Buick Enclave. What's interesting about this, Scott, is this is a case of the company saying, look, we still see strong demand out there, especially when you look at crossovers right now. There's strong demand. That's why they're adding that third shift when it comes to the Enclave as well as the Traverse. So again, GM adding 1,200 workers this spring and adding 2 new shifts at its plants in Lansing, Michigan. Scott, back to you.
And we appreciate that from you, Phil. Thank you. That's Phil LeBeau. Let's talk about the banks. I mentioned we had this note from Mike Mayo because banks have gotten hammered this week. And Mike Mayo is out with a note today. He has cut price targets on every big bank in his coverage universe. He's citing the obvious, really, interest rates. We've told you what the 10-year is doing, really all along the curve, how rates are just dropping like a stone. So he takes, let me run you through these. Bank of America goes to 40 from 42. Oh, by the way, he keeps overweight ratings on everything. He has not downgraded the stocks. He's just cut his ratings. That's important to make note of. Citi goes to 94 from 100. Goldman goes to 260 from 300. JP Morgan to 148 from 155. Morgan Stanley to 50 from 58. And he reiterates his equal weight on Morgan Stanley. Remember, he had downgraded Morgan Stanley after the E-Trade deal, so it's important to make note of that too. Steph, why don't you have the first shot at these?
Not surprised at all. I mean, it's not only the yield curve, but it's Fed. If the Fed does cut, and if they do go 75 basis points, that's not priced into these stocks whatsoever. And also slower growth, just economic growth, right? Yeah. So on the flip side, I think they will benefit on the mortgage side, on the housing side. So there's that. I do think the capital levels at these companies is still very robust. Wells Fargo is yielding 4.75%. So back to that whole yield story, actually added to that one because I think it's a housing play, a turnaround story, and then you get the yield. But my goodness, I totally agree. I hope every analyst goes out and lowers numbers next week, get out of the way, and then we can just move on.
Yeah, or maybe by the end of the day. I mean, it's harder to look at a bank stock, Brenda, when you have the 10-year. We just showed it at 116.
It's hard in that environment, and it's hard in an environment where there's all kinds of other attractive growth companies whose stocks have also fallen. So when you're looking where to put incremental money, the financials are inexpensive, but the environment is just, it's challenging, and it seems like it could become even more challenging. So when deciding where to put money, financials wouldn't be our first choice.
Doc, if you didn't like the banks when the 10-year was at 130, you're going to hate it at 116. What do you do with these stocks? Are they all no touch? Or are they down at, look, I mean, in a month, Bank of America, every bank on my list here is down double-digit percentage points in a month. Now, this has been a horrible week, so a lot of it's happened this week, but nonetheless, 15.5% Bank of America, 18.5% for Citi, and 18.5% for Goldman, et cetera, et cetera.
Right. To Mike Mayo's point, and perhaps somebody reacting to it, KRE, just the regional banking ETF, Scott, it's one of the unusual activities, but here it is. They bought puts in there big time today at the 45 strike, about $3 under where that stock is. Now, is that somebody like a Stephanie Link or Shannon or Brenda that is managing a big chunk of money and wants to shore up a little something underneath the market so they can ride out the volatility? Maybe. Either that or it's a straight out downside bet. I would, not know which one of those two it is right now, Scott, but it's a big trade. And obviously the KRE is that regional banking index is one of the ones we keep our eye on a lot because the big banks aren't going to be merging with each other. These guys could.
I agree with everything that everybody has said, and we're neutral. All right, cool. Because hey, let me make the point, though. Everybody is in the same boat. And when everybody's in the same boat, it's reflected in price. And I think if you're really patient, there's some selective opportunities to buy. I would argue that there's really high-quality banks that as we come out of this, you can make money on over time.
The boat has taken on a lot more water.
No question. And potentially more water coming into the boat, depending on Fed action. But I think, sometimes these stocks discount that in advance, and they are trading at a pretty significant discount relative to any other sector of the market. So just
plus I wait for, you get a Jamie Dimon coming out saying he's buying his own stock in situations
exactly
like this,
right.
The diamond bottom. We all sort of remember that's not out of the realm of possibility too. Not necessarily speaking about bank CEOs only. I'm just saying more broadly. You start to get some commentary out there. If I bought, How
about a Tepper? He came on and bought MLPs at the end of 18, and they went on a moonshot rally just because they were so oversold.
I think that this will continue to define how you look at financials. I think there's areas in financials, whether it's, a firm like JP Morgan or whether it's the exchanges, there are areas within the financial sector that you can avoid being completely focused on net interest income. And I think as long as you're looking at it from that perspective, that this will create some opportunities to add to your financials exposure. It may be in one of the larger money center banks, provided that they're focused on increasing their fee revenue. But it certainly we were looking for a tailwind for financials coming into this year, and that's certainly taken some of the wind out of that.
There's some talk today. I have so many notes in front of me. I don't remember who said it, to be honest with you. But somebody was out there urging that you should buy a MasterCard or some of these credit card stocks that have pulled down hard as some of these other stocks have gotten hit as well. Forgive me for not having that at the top of my head, and I'll try and find it for all of you. What do you think about that?
But they're still trading at 33 times forward estimates. I know that they're great companies, and it's kind of like a duopoly environment, but they're not cheap by any means, and they definitely have some real earnings risk. We saw it with MasterCard. I think PayPal is more de-risked because the multiple is much less and the stock has come in so much more, and they had a crappy year last year, and I think they're really turning it around this year. So if you're in that space, that'd be the one I actually own it. That's the one I've been picking away at. But the other two they're still just too rich on valuation for me.
Jim did a segment on stay-home stocks yesterday. I think that you have to think about...
And I have those too. Keep talking. No, you keep talking. Okay. Go ahead. I'll find those too.
And so I think if you're looking at it from terms of how the consumer is going to spend money, I still think that if we get a continued increase in the number of coronavirus cases and we start to stay home more, I do think there'll be less consumer purchasing. And I think that this, from a transaction perspective, you have to keep that in mind. I still think that if we get a
Walgreen Boots Alliance with everybody going into the drugstores to stock up on all the, not just masks, because now it's more and more, Scott, they're telling us the masks are for protecting your expectorate from going on to somebody else. It's not keeping that inhalation, keeping you from getting that through inhaling.
I think Amazon's a better play there because consumers have to go to the store. Costco is a better play.
It's a run on all sorts of stuff, by the way. I was in the city yesterday, and I ran into a couple of drugstores to try and get some hand sanitizer.
I think
isn't that pulling forward a lot of
major chains are doing that. Let's go to the credit card thing. My executive producer told me which note it was, so I was able to find it. All right. Wells Fargo advises picking up credit card names 3% today. So it's had a great week. As one of the stocks, my pal, I see him in my peripheral vision, is going to sit down. You going to sit down? You want to sit down?
All right. No, I'm going to just stand here like I'm going to stand.
Well, I thought you were walking up here.
Darn it.
Thought you were walking up here.
Put me in, Coach.
With the linkster?
Are you going to be right there? All right. What made you run out? Well, we don't even have a microphone on you. Hold on. We're going to talk amongst ourselves. We'll get a microphone.
What made me run out is we gave the stay-at-home stocks.
Stay-at-home stocks, Kramer.
This is not a natural time.
We're getting a mic for you, Jim. Some of these other names, Square. What? No one owns Square?
I own Square.
Square.
Yeah.
So you
threw 85 yesterday.
You can tell Jim and our viewers why you agree or disagree with him, and then we'll get Jimmy set up.
It's just a processor, as you know, and I think a lot of the things they're doing to compete with a Venmo, even, I think are effective, Jim. They're not going to be taking out PayPal and Venmo, but I like what they're doing as far as Square.
I think Square is this tremendous. When Sarah Fryer was running it, they have this tremendous business where they have your receipts, so you can get a loan. And it's just great. And their cash app is great. You have to read Lisa Ellis. Yeah. She is at MoffettNathanson. Well, I like this guy.
The lighting's not good.
I miss him already.
The lighting isn't good there.
You look like the shadow over there.
We love when spontaneous stuff like that happens.
Absolutely.
But, I think Square is also what Lisa said that I like. Is she said it could also be taken over very easily. And you know that PayPal could buy them.
Yeah.
Can I ask you this? Just moving away from this for a minute. What do you make of the action in the market an hour ago, where the Nasdaq went from positive to down 1.5% again in the blink of an eye?
Algos. Yeah. The algos. I wish they could somehow get rid of them. Wow. I'm taking slower than
fix your mic.
But look, I think that what's happened is that this is something that we talked about, recouping, which you're going to do. I mean, the machine's control. So if interest rates tick down for a second, it just immediately flashes to red. So this is a great opportunity, if you believe in certain stocks, to buy them at a discount, particularly high growth tech.
Watch your mic.
My daughter got me this tie.
We should be restoring order with the uptick rule, though. We should all be championing that because it creates a lot of irrational volatility.
Right. But, they won't, because the guys who run the system are way too powerful and they want a lot of trading.
Watch your mic. I'm just looking out.
Guys, can you give me a hand, Les? Give me a hand here, Les. 112. And somehow take my seat down. This was outrageous. It was outrageous that I just dropped in, but these are special times.
Yeah.
And when you were talking about some of the stocks, and I'm here at the office,
happy to have you, yeah.
It is absolutely imperative that I come in because we all want to find things, I believe, that actually work. Yeah. And the ones I picked were ones that work better remotely than they do at the office.
And you don't worry that the stocks that you picked aren't down enough?
But look at Trade Desk, okay? I kept waiting for Trade Desk to be down, but then they reported this great quarter. And it's not going away because what do? If you cord cut, that's who you advertise. You use them to get the millennials who love cord cutting. I mean, my kids don't have cable, which is insulting. But there is absolutely, without a doubt, a Zoom. Now, I know people feel Zoom's moved too much. But when I had Eric Yuan on the show, Eric Yuan is just saying, I'm the collaborator with every one of the companies that you love. I'm collaborating. Now, there's a lot of stocks that I think are really problematic that I don't want to buy. Yeah. Not yet.
Do you think some? We said these what is it, like 5 or 6 of the big cap tech names, the marquee ones. That's what I call them. They've erased $1 trillion out of those stocks in 7 days.
But look at those charts.
Down enough?
No, look at I'm not a chartist, okay? But when you look at the longer-term chart for, say, an Apple, and I love Apple, it's still too early to me. It just feels too early. That's the chart. You're looking at... Okay, right now, Steph is looking at the exact same chart that I'm talking about. And if you saw it, you would see that it's just rolling over.
The 5-year of Microsoft.
I love Microsoft. I think that Dell is terrific. I believe, by the way, in Instagram, not as much Facebook. And I think that Alphabet's going to break out. So I don't mind buying Amazon. Look, these are companies. They're built for non-China commerce that is at home, uniquely at home for these. Whether it be search at home, or whether it be Amazon at home. So they work in this environment. I mean, now maybe they work in every environment, but this one in particular, you want to stock up, you go to Amazon.
Did I hear you correctly that Apple? Did you say
I think Apple
hasn't come far enough?
I think Apple can still fall more because Apple has a twin problem of manufacturing in China and selling in China. And I think we all recognize that whatever we hear about China seems like a pack of lies. We own Apple from a charitable trust, so don't need to buy more. I would love to tell people this is the level, but I still think it can come down a little.
I mean it's $50 now off of its high.
Yeah, but that's not that much. But you know, look, here's my problem. Let's say we come in on Monday, and a world leader got sick, or we have this community outbreaks everywhere, where it's almost like for all of us, I know no one's here as old enough as I am, but when the measles broke out, or when polio broke out, and I was alive for these, I mean, these are far worse than this coronavirus, because they wreck your life. I mean, measles can kill you, and polio, well, we all know what polio did to people. So, this is what happens when you come out and you're not supposed to drop in.
So how do you...
I love you, though,
yes.
and I never miss your show.
We appreciate that very much. How do you then sort of advise people to parse what you're saying with, if you have money and you're thinking long term, you got to put some to work with Apple, the biggest and best name in the market, the most valuable, could come down more.
But I think that I recommended this morning, I don't think travel and leisure has a place in a portfolio. When I spoke to Doug Yearley at Toll, he does not predict it. He's saying, listen, we got to wait and see whether the spring selling season is good. Selling season is good. I don't think housing belongs in a portfolio. I certainly don't think, and listen to Phil, that you want to be, I mean, I don't even know if I want Boeing. I like Boeing, but now I don't want it in my portfolio because the airlines may not be able to pay. So those are all sources of funds to buy these really great stocks that we've been waiting for them to come down, and we can't avoid them. High growth works. Mm-hmm. Does everyone agree? High growth?
No. But to your point, though, look, some of these airline stocks, Jim, are basically
Southwest should be at 36, where it was before the president was elected. But I'm just saying that's where you buy. Most of the people don't have money. They're already.
So it should be $10.
So can they buy So can they buy Nvidia, which I like so much? They have to sell something, so I'm offering what they should sell. I'm offering what we call the source of funds.
How do you not own something housing with rates where they are?
Because Doug nearly made me feel. Doug made me feel so badly about it.
He's having issues.
Toll's pretty good. You want to do Lenore?
I would not D.R. Horton.
I like Horton.
But I would do Stanley Black & Decker. I'd do Home Depot down 5% today.
Now Home Depot works. They reported a long time ago.
Yeah.
What? Like 72 hours ago?
No.
I mean, Home Depot does work. Plus, it's gardening season. You're going to garden whether you can be sick. Let's think about this. You can be sick for 2-3 weeks, okay? I am at an age where I know CDC says I'm at risk. I will hopefully get better, and then I'm going to do my planning like I always do. And it's a corona, which means that once you get it, you're not supposed to get it again. Of course, we wish the Chinese would tell us. But I think Home Depot, uniquely, you just found out.
I would even do a PPG.
Jen.
Wow.
Trex, CoStar.
Wow, you would do PPG?
I would.
With Michael?
It's down 20%.
All right, then I'll see you and raise you Costco.
Well, I'd take Costco. Well, we talked about that before.
Yep. How about J&J at 132? It's finally back. AAA balance sheet. Great pipeline. Oh, no, I'm sorry. I might feel sick.
How about healthcare as a group?
Well, if Bernie gets knocked out on Tuesday, you're going to wish that you bought even the worst of the worst.
Agreed with that.
Or
you may even want Pfizer.
Well, how about United Healthcare? How about some of the HMOs?
I'm in a fight with United Healthcare, so it's a different story. But I think that I like CVS, and I know it's hated, and Merlot is hated. And, it's like, well, you ought to change his name to Pinot. I mean, this guy's just hated. I like CVS, and I think it's got Aetna, and I don't think it's too much. And I know people worry about the debt. I prefer Gill. I think Gill's very good. Anybody like Gill?
So we have only a couple minutes left.
I know.
And I do want to get final trades if you all have them. Maybe you don't.
And I want to apologize. What I did was very rude to everybody.
No, we love it. No. Can you just leave our viewers with the most important thing that you're going to be watching for the rest of the day?
Okay, I'm going to be watching one that I have not liked in ages. I'm going to be watching ATT. I cannot believe I said that. I think it's a totally second-rate company, but it's got a first-rate activist involved. And I love that yield against what the treasuries are doing.
That's Paul Singer, right?
And I like him. He's actually really nice. People don't get that.
You say you're going to be watching what the treasuries are doing. I mean, it's hard to feel good about a bottom if you have these yields that continue to go down. Really across the board. I mean, the 2-year is below 1%.
Well, look at those. I mean, if the Chinese were to sell their $1 trillion in treasuries, at least we get a little lift. But no, they are uniquely doing everything wrong. I mean, you know who she is? He's Khrushchev. He's not Stalin. I'm giving him a real break.
We're so glad you ran out. We love the spontaneity, and we love having you.
And I like people to pick at things that, as I said this morning, stop with the fear. Okay? Stop. Go buy some Lysol, for heaven's sake. But stop with the darn fear. Do what the CDC says. Do what they say. And you're going to beat this thing. And when you beat it and you come back, you're going to say, what the heck? I didn't buy any Microsoft because I got sick.
Let me 30 seconds left. You have a final trade?
Farfetch. FTCH. Got a couple upgrades today. They're buying the April calls at 13 strike.
Dividend growers and quality at a reasonable price. 2 ETFs you can buy right now.
Disney, seen a significant correction. Disney Plus should be well positioned in this kind of environment.
Okay, that's an interesting call. Been talked about a lot this week.
Anthem expected to grow EPS 10 to 15% over the next couple of years on cost.
Bernie's dying.
Zoetis growing 10%. I emailed you this morning.
That's why I knew it.
This is what it was like. Jimmy, thank you again.
Thank you, buddy. Have a good weekend, everybody. Stop fearing.
And Brenda.
Stop fearing.
The exchange starts now.
Thank you, Scott and Jim, and hi, everyone. I'm Kelly Evans, and welcome to the exchange today. It's another wild day on Wall Street. As this record sell-off continues, here are some staggering stats that sum up where we are today. The Dow, the S&P, and the NASDAQ and the Russell are all down more than 13% this week. For the Dow, that's a drop of more than 4,000 points. The major indices having their worst week since October of 2008, which we all remember as the heart of the financial crisis. Every Dow stock is in correction, with nearly half of them more than 20% below their recent highs. And the S&P, 98% of companies are in correction or worse. Every sector is down more than 10% from its highs, with energy the biggest loser. It's off 34%. We'll have more on that in a bit. In the bond pits, the 10-year yield, get this, today hitting a new record low of 1.155%. The 2-year is below 1%. And the sell-off is global, with almost all foreign markets down at least 10% from their highs. For more on today's action, which has been quite as dramatic as the week, let's send it down to Bob Bassani at the New York Stock Exchange. Bob?
It's been remarkable. The entire global stock market is down 12 to 14%. And even here, the NASDAQ, the S&P, the Dow, the Russell 2000, all of the major sectors as well. Even REITs are down. Even utilities are down dramatically. They've just taken everything down. You're not going to see this very often. I want to show you the S&P in the last couple of days because we have made attempts to call bottoms yesterday, and it didn't quite work because the headlines turned against everybody and the market dripped lower. We're trying to do this today. We don't have any major headlines to deal off of in the middle of the day, but the important thing is everyone's playing what I call the capitulation game. Is there enough selling that is indicate exhaustion of the selling for the moment, and we're going to get a natural rise up because there's just more natural buyers? We're not quite there yet, but we are been bouncing in the last since the early morning here. Here's some things to watch. Look at some of the big stocks that are oversold in the last few days. Microsoft, for example. Exxon down 15% so far this week. Cisco and Apple, they're all holding up fairly well right now. That's important, and I think that's a good sign that at least there's some buying interest as we're down here. Transports, Ryder, for example, FedEx down 15% this week. Expeditors, UPS. The important thing here, you want to look at UPS here, been the stuffing kicked out of it, all holding up in the middle of the day. Obviously, that's not a complete sign of capitulation, but it's a good sign at least that there is some buying interest out there. Guys, back to you.
Okay, Bob, we appreciate it. Bob Bassani in the middle of the action, and so is Rick Santelli as rates continue to fall, with the 10-year hitting a new record low. The markets are now pricing in 3 rate cuts this year. Mr. Santelli is out in Chicago with more. What do you make of this action, Rick?
Well, let's go in reverse. In terms of the rate cut action, all markets have moved dramatically this week. So has Fed Fund futures because it acts much like a T-bill market. So in deference to that, it doesn't surprise me that when you put a math premise onto that to figure out the statistics, it's adding in 3 eases. But at the end of the day, we have to watch the way the market moves. I think Bullard had it right. once the market stabilizes a bit, maybe we can see what Fed Fund Futures outlook changes to. Look at an intraday of 10s and recall that we settled so much higher last week at 147 that at 117, we're down 9 on the day. Go to a 1-week chart, down 30 basis points on the week. And if you think that's wild, a 2-year note now is down 42 basis points on the week. So it settled last week, and if you do the math, its settlement means that from 136 last week to its current trade at 0.94, it's down 30%. That's why I never use percentages with yields. Finally, a January 1st to the TY VIX. This is the VIX index for 10-year notes. And it's over 7.5%, the highest level since early 2016. Kelly, back to you.
Yeah, it's enough to make your head spin, Rick. That's for sure. We appreciate it, Mr. Santelli. Well, while coronavirus cases in China may be slowing down, the opposite is now true for the rest of the world. Meg Terrell is here with the very latest at this hour. Meg?
Well, hey, Kelly, the World Health Organization, with the numbers around the globe continuing to climb, the World Health Organization today raising its risk assessment level for the rest of the world to very high. That's the same level it's had for China since late January. The WHO emphasizing there's still a chance to contain the virus if robust action is taken to detect cases early. The CDC just now saying it's shipping out more testing kits to state and local labs. This as they investigate that case in California that could be the first instance of community transmission in the U.S. And Bill Gates issuing a warning this afternoon. In an editorial in the New England Journal of Medicine, he writes, quote, "In the past week, COVID-19 has started behaving a lot like the once-in-a-century pathogen we've been worried about," and says in addition to responding to this crisis, billions of dollars must be committed to preventing future ones.
Geez, Meg, I hadn't seen that Bill Gates thing. He's going to scare, I mean, that's some scary stuff. I understand they have a lot of involvement with various health initiatives. So I guess if Bill and Melinda Gates are saying this is the kind of pathogen they don't want to see, you got to take notice.
Yeah, they actually have committed $100 million to the WHO to try to help fight the virus around the world, and especially in developing countries where the health systems are weaker and where WHO is especially concerned about this potentially spreading. But one of the things he says here in this editorial is that it's such a threat because it can also kill healthy adults in addition to older folks and people with underlying conditions. So that obviously is incredibly scary.
Still, the mortality rate is relatively low. I mean, as it has spread around the world with a ton of different types of systems, and not just China's that we had to rely on at first, are the stats about this changing, or have they changed at all in terms of how many people tend to die from it once they're infected?
Well, they are still evolving as we learn more, and especially outside of China. A lot of the estimates for the fatality rate are starting to sort of focus on about 1%. Now, that is a lot lower than SARS at 10%, a lot lower than MERS at 30%, but 10 times higher than for seasonal flu, which is 0.1%. So a lot of concern.
And it's true with coronavirus, you keep getting it, right? I mean, which is why, look, we've already had reports of at least one woman who has apparently gotten it twice. So this thing could come back if we don't, but that's why we hope we have some sort of vaccine or better treatment by next year.
That's something people are trying to figure out. Can you actually be reinfected with this fairly quickly? Or is that report and others of reinfection really just detecting the virus in people after they have technically recovered? We don't actually know that much about the possibility of getting reinfected very soon.
Okay, great point, Meg. Thank you for now. We appreciate it, Meg Terrell. Let's get back to the markets where stocks are selling off again today because of all of these coronavirus concerns. Joining me now to discuss that, Guy Labat is Janney Montgomery Scott's Chief Fixed Income Strategist, and Jim Paulson is Luthold Group Chief Investment Strategist. We've got a bond guy and a stock guy today, and we appreciate you both being here. Guy, let me just start with you, because in some ways I think the action in rates is even more dramatic than the action in the stock market, believe it or not. Do you see, based on charts or fundamentals, what you look at, that we're near the end of this move yet?
Well, I suspect so. I think on the long end of the U.S. yield curve, out 7, 10, 30 years, we've experienced what I might describe as a bullish overthrow, with yields coming down faster than I think the underlying data, both in terms of the probability of rate cuts and inflation and those other factors, really justify. That said, the degree of sort of panic buying in longer-term bonds is really palpable, and I doubt that really subsides until we get a little bit of stability on the equity and the risk asset side of the equation as well. But once it subsides, we could have as much as a 20 basis point backup in 10 and 30-year yields.
What has typically happened, Guy, because in the stock market, when we've seen these very sharp corrections since the rally began over a decade ago, we've also seen very sharp recoveries. Is the same true of bonds?
Well, not really, because one of the most likely outcomes here over the next 3 to 6 months, as Rick mentioned a couple moments ago, is that we do get Fed rate cuts. And as a result of those Fed rate cuts, the absolute level of yields across the curve is going to come down. I'm just arguing that the long end of the U.S. yield curve has come down further than those probable rate cuts really justify at this point. So shorter-term yields are likely to sustain at lower levels, whereas the long end is more likely to back up.
All right, Jim, let me bring you into this conversation, kind of reflecting on history and different, whether it's health outbreaks or just financial panics that you've seen. How would you describe what we're going through right now?
Well, it's certainly a full panic. You know, I'd say of all of them that I've seen or been through, it really kind of reminds me of 1987, the 87 market crash. Now, that was a much bigger one for the day, of course, but both of them came in with a healthy economy, and indeed we had a pickup in global growth going into this, and we certainly have a pickup in the United States and still do, just like we did in 1987. It was caused by different impacts, mostly tightening back then than this one, but when it happened, it didn't really matter what caused it. It was all about the collapse itself. It was all about the market falling without any noticeable bottom. And it was a combination of fear and program trading. And I would say we got exactly the same thing again today. Now, the reality of that was, even though today's is the fastest drop ever and that was the biggest drop ever, it fully recovered because underlying all was a fairly healthy economy. And I think that's what we still have here. You know, what we're doing today, Kelly, is we're trading on what if rather than on what is or even what is most likely to happen. I think it's kind of what if to our worst fears right now. I think that's going to ease, and I agree with Chi that if it does, I think there's a pretty good bounce. And if I think ahead 6 or 9 months, I think we're going to see we lost a quarter of growth and then a recovery comes.
Okay, we got to go now. But Guy, you probably saw the quotes from Fed member Jim Bullard earlier this morning where despite the calls by Kevin Warsh and others to do something immediate, coordinated central bank action, Bullard was saying, no, not until this thing becomes more of a pandemic. Is that what upset the markets and sent us to the lows, you think?
Well, it certainly didn't help, right? I mean, Bullard usually tends to be on the bullish side, on the, dovish side of things. And having a little bit of a cautious tone from him certainly didn't help. But I fully expect over the course of the next week that we're going to see a parade of Fed officials come out and express confidence that we're going to, some equivalent of, we're going to do the right thing to ensure liquidity and support the economy, which is really the precursor to rate cuts. And they could come much sooner than we might expect.
Okay, that remains the big open question. We'll leave it there, gentlemen. Thanks to you both, Guy Labas and Jim Paulson, on the markets today. And it's not just equities that have taken a hit this week. Oil has gotten hammered as demand fears grow. We bring in Brian Sullivan with a look, Brian, at the damage this has done.
You know, Marcus Lemonis may be the prophet, but if I keep covering oil and gas, I feel like the prophet of doom, Kelly. It has been a rough week for retail stocks, by the way, but forget about that. Let's talk about oil and gas. All right, first off, the XLE, worst week since 2008. Now, a lot of sectors you can say that. Whether it's 08 or 11, either way, the XLE, one of the bigger ETFs, awful. Look at these declines this week. This is this week. Okay, these are big companies. Exxon down 14%, 6.9% dividend yield. Looks kind of good, I guess, to some. Chevron, Marathon, and Occidental. Occidental has lost a quarter of its value this week. Now, as far as the staggering stats go, Kelly, let's talk about this. 27 mid-major oil and gas stocks have lost 50% or more of their value this year. In fact, many companies, because the debt loads, are trading as if oil was at $15 a barrel, not $45 a barrel. Now, ironically, in the last hour or so, Kelly, you had a couple bids come in. Some of the oil and gas stocks are actually higher right now. Maybe it's cherry picking, maybe it's programmatic trading, to Jim Paulson's point just a moment ago. Either way, we are starting to see some bids. But look at this. The XLE down 28% in 1 year. I mean, it's not quite straight down. It's a double black diamond in ski terms, and that's how it's been. There's a feeling, Kelly, I guess I'm going to walk and join you.
Well, I was just going to say, that's more than a double black diamond. That's like
invitation.
you're tumbling head first down a hill. We don't see action charts that look like that, Brian, and you just said something
apparently we do.
Well, now we do, you're right. But what you just said about Exxon I find really interesting. You said it has a 6.9% dividend yield.
Yeah.
Now, the only time you usually see dividend yields that high is if there's maybe some question the company can't pay it. Is that any kind of question to even raise here, or is that ludicrous?
I don't think it's ludicrous. No, first off, I don't think anything you say is ludicrous. But I think that, listen, I mean, they've got plenty of cash. Exxon has cash. Chevron has cash. But many of the other equities, the names that we kind of talk about sometimes, they're trading as if they're going bankrupt. We're going to hear from Darren Woods. I think Darren is on with Becky Quick coming up next week.
The Exxon
He's the CEO of ExxonMobil. I'm sure that question will be asked. How safe is your dividend? Remember that Chevron years ago, when everything was, all that stuff was hitting the fan, they held on to their dividend. I mean, it basically they gripped it tight and everything else could go. What I do think you're going to see, and the people I've been talking to, is you're going to start to see a round of capital spending cuts. So let's say a company was going to spend $5 billion this year. They're going to spend $3 billion, and I'm making the number up, $3 billion this year. What does that mean? It means job growth slows down and industrial machinery. I like these random stats.
But before you give that, just so people realize, this is how this is transmitted from financial markets back to the real economy. When you start talking about pulling back on capital spending, less money there, obviously less to go around. Now, what were you going to say?
The oil story is a job story.
Yeah.
It's a debt story and a job story. That's it. I mean, whatever you put in your tank, who cares? It's an oil and job story. It's a debt and job story. I love these RBIs that I used to do, random but interesting. This is random but sad, RBS. On May 9th of last year, Occidental bought Anadarko, announced the first $57 billion deal, including debt.
Contentious one, too, yeah.
Occidental's market cap today with Anadarko is $28 billion.
Wow.
So they paid $57 billion for Anadarko.
And the combined entity is now worth less than half of that.
The combined entity is worth $28 billion.
Wow.
Random but interesting, Kelly.
Random, like you said,
Random
but sad. Yeah.
RBS.
All right, Brian, thank you very, very much.
Welcome.
Brian Sullivan. It has been a rough week for the retail stocks, too, and today is no exception on that. Let's get over to Dom Chu with the very latest there. Hi, Dom.
All right, so you think, Kelly, with the conversation you guys just had about lower fuel prices and energy stocks, that the consumer would actually benefit because we're paying less in gasoline. We can spend it on other things. It's not exactly playing out that way, as fears over the coronavirus have now hit the consumer spending picture. Remember, it's been one of the pillars of the global economy. If you look at the consumer discretionary sector ETF that tracks it, just on a one-week basis, it's already down 12%. The retail industry overall, tracked by the Spider Retail ETF, XRT, down 12%. That tracks some of the more mid and smaller cap names as well. But take a look at some of the real laggards in trading so far today. If you look at the overall picture for, say, dollar stores, which could have, by the way, supply chain impacts from places like China, Home Depot on the consumer spending front down 3%, even big box stores like Target down 3%, and Amazon.com is an e-commerce play still down 1% in trading today. And then on the flip side, we want to balance it out with some green shoots here. Take a look, though, at Ralph Lauren, Capri Holdings, the company formerly known as Michael Kors, Tapestry, Macy's. Many of those stocks have been hit hard recently, but are showing some signs of life today. So, yes, maybe some short covering, maybe some fundamental buying. Kelly, the retail, the good and the bad, back over to you.
Yeah, I'll go with green shoots this time of year, Dom. We appreciate it. We'll see you again soon. For more on the consumer and how all companies should be planning for a wider coronavirus outbreak, I'm joined by Steve Odland. He's CEO of the Conference Board and a CNBC contributor. Steve, welcome. It's good to see you. And first of all, do you guys pick up on anything in the last couple of weeks since your latest monthly confidence survey that shows a hit to the consumer here?
Yeah, the Conference Board survey in February didn't pick anything up. We're sitting here at very, very high levels, almost near all-time highs. But this is a really important measure, as you know, Kelly, because most of our economy is driven by consumer spending. So we watch this. Now, the Consumer Confidence Index is driven more by jobs and wages, so how the individual consumer is being impacted, and less by the rest of the noise. So far, the consumer is unfazed. But I think if you did it right now, you'd probably see a slightly different picture because everybody's a little bit more afraid. Fear is driving this thing. You see fear driving markets. The question is whether fear will impact consumer spending. Now, I think what's going to happen is that you're going to have people avoiding large crowd situations, staying out of the malls, staying out of sporting events. So you're not going to see a level impact from all of this. You're going to see different industries, travel industry get hit, oil, as you said, but you ought to see in-home eating go up. You ought to see things like home delivery, Amazon, be affected positively. So, Netflix, home entertainment. So things that you can do at home in small groups ought to go up while people are trying to avoid these other situations.
So let me ask you, given your experience, Steve, in the CEO office and on boards and so forth, there are companies across the country now who are trying to think through their coronavirus planning, and hopefully a lot of them already thought this through before today, but now I'm sure everybody is. What are the kinds of plans they need to be making? I mean, are we talking about coming up with another way for employees to work from home and those kinds of things? Is it supply chain? I mean, what are all the various factors that need to be considered here?
Yes, yes, and yes. So you ought to be focused on your customers and your employees first and foremost. So from a customer standpoint, every company should have some sort of disaster team in place that's cross-functional, thinking across manufacturing, supply chain. If you're a manufacturer, you need to understand where your ingredients or your componentry is coming from to make sure you've got alternate sources of supply so that you can take care of your customers. From a supply chain standpoint, you've got to make sure you can get it there. From a consumer standpoint, you've got to make sure that you're responding to your customers. If your customers are expected to come into a large gathering, you've got to do some sort of virtual coverage of that. From an employee standpoint, everybody should be testing virtual employee work, okay? Because, at some point, you're going to come to the point where you're going to say, look, this is too dangerous to bring everybody in. So you've got to test this right now and equip your workforce for this. Then you've got to be going through all the contingency planning now, and then, maybe you just want to start pulling the trigger on this stuff because, the insurance is worth it.
I was just looking up Slack as I'm thinking through this. Everybody knows it's a messaging system people use now. It's up on the day, up 1.5%. And there are these tools, Steve, you can use now that we didn't have before. And I wonder if there will be a lasting impact from this even after the virus passes.
Well, it's very interesting because every one of these kinds of I guess, crises or disasters, whatever it is, does impact us. It changes behavior. If we can find out that we can work remotely, well, why do we need all that real estate? Why do we need to force our employees to come together every single day in large gatherings? You need to provide some of that. But maybe that will change work more rapidly than anything in the gig economy over the last 20 years.
Exactly,
I don't know.
Exactly.
But these are the kinds of things that you can have happen, through this situation. Maybe that'll be great. Maybe it'll help work productivity for the long term. So maybe there's some, as you said, green shoots. Maybe there's some light at the end of the tunnel. But look, the issue is that there's unknown here because this virus is unlike any other, as you said before. People are getting sick without having symptoms. They're passing it through. So I think that businesses need to be more cautious than you've ever been before.
One final point on that. Just earlier this hour, about 20 minutes ago, Amazon said it was asking all employees to defer non-essential travel, including in the U.S. Do you think that's prudent? Again, we're seeing a number now of major companies line up and do that. So you said they need to be more careful than they've ever been. Is that prudent, Steve, or is that an overreaction that's going to worsen the economic effect of this?
You've seen it from Nestle worldwide in Switzerland. They've got the car show in Geneva that's been canceled. You've seen it from J.P. Morgan saying all non-essential travel. I think if you look at level 2 countries, watch the State Department site, watch the CDC site. I think, all disaster relief folks in companies, CEOs, C-suite should be watching those sites and taking their guidance from those sites and being consistent. We should have non-essential travel backed off. I don't want to kill the airlines, but at the same time, why put your employees and your customers in harm's way?
Right. Okay. So like you said, prudent from each of these companies' point of view. We just have to understand the toll that it can also be taking. Steve, it's great to see you.
Kelly.
Thank you. We appreciate it. Steve Odland with how companies should be thinking through dealing with coronavirus. Well, the Trump administration is trying to calm the public and the stock market this week, with White House economic advisor Larry Kudlow weighing in again earlier today. Eamon Javers is live at the White House with all the news there. Eamon?
Yeah, Kelly, the message from here at the White House is don't panic. Larry Kudlow, the National Economic Council director, as you say, came out to talk to reporters earlier today. He said ultimately he thinks the risk to Americans at this point is still low. That's still where the administration is in terms of projections. I asked Larry, though, about this idea that's been kicking around Wall Street for a couple of days that the president might respond with something dramatic, perhaps up to and including the idea of suspending all the tariffs against China. Larry Kudlow said he doesn't think something like that is in the offing. Here's what he said.
We have no precipitous actions right now. Again, it's sometimes a hard case to make in the middle of one of these crises. which is part psychology and part fact. But I just don't think anybody ought to panic right now. And we are going to stay the course on our policies.
So no massive mobilization of policy here from the White House today, but a tone overall saying, look, everybody needs to settle down and take this in stride. Mick Mulvaney, the acting White House chief of staff, was speaking at an event this morning. He was asked for his advice to calm the markets today, and he said, look, everybody just needs to turn off the TV for 24 hours, Kelly.
You know, Eamon, this weekend we're going to see, all the Sunday shows and all the pressure from politicians on the White House to say you need a better response here, you need to step up. Do you expect by this time next week that we'll see more of a coordinated plan, maybe something that comes out of the coronavirus task force even, maybe something in coordination with the CDC to provide us more daily updates? It does feel as though there needs to still be some kind of regularity and communication with both the market and the public about what's going on here.
Look, if that comes, it's going to come as a result of the vice president sort of taking over that coronavirus task force. There's been a lot of sort of diplomatic niceties of who's in charge of it, but right now it is the vice president and his team that are running the response from the White House. And it's also going to come from the president of the United States. And I think it's important to note that the president just has not really wanted to embrace the idea that the coronavirus is causing the stock market to go down. Over the past 2 days, 48 hours or so, twice, he's offered up as his primary reason for the stock market decline the Democratic debates, right? He acknowledges that the virus is part of this, but he's pointing to the Democratic debates and saying that's what's causing this market sell down. He's done that twice now. So this is a president who's looking for other reasons to explain this market sell-off right now. And I think that is sort of impacting the way the White House is responding to this. And by next week, that might change, but that's where we are right now.
Eamon, one quick final point on this. Do you think any further steps are under consideration in terms of curbing travel into the U.S. or any measures that, again, the U.S. was complimented for being early to shut down flights from China, but doing something more to try and basically solidify our border as this continues?
Yeah, look, the president was asked about that earlier this week. He said not yet, but look, things change, and I think they're going to monitor all of that and decide at some point they've got to hit the toggle switch, but they're wary there of having anything to do with any kind of major economic consequence of a decision like that. So how far-reaching that is going to be the other question.
Yeah, all of this, such a double-edged sword. Eamon, thanks. Right. We appreciate it. Eamon Javers at the White House. Now to Sue Herrera for a CNBC News Update. Hi, Sue.
Hello, Kelly. Hello, everyone. Here's what's happening at this hour. A major fire in the area of the Gare de Lyon train station in southeastern Paris, with thick smoke visible for miles. French police tweeting that the railway station had been evacuated without commenting on the causes of the fire. That's a live look. It looks like most of that fire has been damped down at this point in the early evening in Paris. Illinois Governor J.B. Pritzker and Chicago Mayor Lori Lightfoot say they, quote, successfully contained the coronavirus to 2 confirmed cases in the state, and they are monitoring travelers for further cases.
The risk is low. The level of preparedness is very high. And in the event that we need to scale up our efforts, we are uniquely qualified to do so.
And the biggest ovation at a hockey game last night came for someone in the stands. Fans honoring St. Louis Blues player Joe Baumeister, who suffered a, quote, cardiac episode at a game in February. The Blues then went on to beat the New York Islanders 3-2 in overtime. It's good to see him back in the stands. That is the news update this hour. Kelly, back to you.
All right, Sue, thank you so much. Sue Herrera. Now, the travel stocks have been staging a surprise reversal today. Dom Chu is back with a look at a sector that could be key for the broader market finding a bottom here. Dom?
If there were value stocks to be found, it could be in some of these travel and leisure names. First of all, take a look at some of the price action we're seeing so far. It is of note because if you take a look at the stocks individually, Norwegian Cruise Lines, Royal Caribbean, Carnival, Marriott, Booking Holdings, many of these travel-related stocks have been hit especially hard given the coronavirus concerns and fears that they will not make up revenue if people aren't traveling or taking vacations. So those stocks, yes, may have been a big sell, but today at least, maybe again, some short covering or fundamental value buying. Also take a look, though, at some of the other parts of the market that we are watching overall, and that is the airline stocks. They have not managed to catch a bid. Those falling demand concerns hitting those airlines hard far, despite the fact fuel costs are going lower. And one more place to call attention to right now, the Dow Jones Transportation Index, one of those indices we watch as a possible leading indicator, still very, very much heading for a bad week. Could be one of the worst weeks on record for the Dow Jones Transportation Index. One of those leading indicators you can see there, down about 11% so far on a one-year basis. We'll keep a close eye on that particular ETF that tracks Dow Jones transport stocks. Kel, back over to you.
That's a great point. Down another 1.5% today, so no green shoots there. Thank you, Dom. Ahead, mortgage rates have fallen sharply, but they can go even lower. We'll explain. Plus, some parts of the high-end auto market are practically grinding to a halt. We've got that story. And 7 days, 6 companies, and $1 trillion. Here's a look at the market cap that was lost in a week by some of the world's biggest stocks. We're back in 2.
We set out to make the best bike on the market, find the best instructors in the world, and tie it all together with the world-class software experience. We ended up creating, as you all know, so much more. Peloton is truly a category of one, and we're just getting started. Now, let's do this. Together, we are going further than we ever thought possible.
Are you guys CIA?
We got made by a 9-year-old.
What's the option?
Killer. Make it look like an accident.
Still recording. Teach me how to be a spy.
Watch me! Watch me! Do this!
Looks like the wedding at the end of Shrek.
My Spy. Rated PG-13.
Who's ready for a great ride? Ready to work out my constipation? It's been so long.
Let's not talk about constipation.
Come on, everybody, work it out.
Say no more to occasional constipation with clinically proven effective Seneca. Satisfaction guaranteed or your money back.
How's the IT department liking the Now platform?
Every time it takes care of something for us, we celebrate.
How often does... Got it.
ServiceNow, the smarter way to workflow.
At Fidelity, online U.S. stocks and ETFs are commission-free. And when you open a new brokerage account, your cash is automatically invested at a great rate. That's why Fidelity leads the industry in value, while our competition continues to talk.
Does hair loss run in your family? Are you losing your hair?
You can now treat hair loss at home in just 6 minutes a day with a laser light therapy that's been clinically proven to treat hair loss and regrow thicker, healthier hair. It's called the Capillus Laser Cap.
Laser therapy is an FDA-cleared treatment for hair loss. What laser therapy does, it reboots that blood supply. It reestablishes blood flow, oxygenation. It's a very effective treatment for hair loss.
Using the cap is very simple. I sit pretty much right here, watch TV, and I have it on. It's completely comfortable. You forget you have it on.
I just put it on when I watch the TV, and I got my hair back.
I feel like it truly has changed the way I see myself.
If you notice it, do something about it. Don't wait, because the longer you wait, the worse it can get.
Get the results you want or get your money back. Payment plans are available. Call 1-888-474-0056 today or go to trycapillas.com.
The biggest day of the race so far. 14 states and over 1,300 delegates in play. We'll be with the campaigns at the big board, breaking down the results of Super Tuesday. All-day coverage Tuesday on MSNBC.
Welcome back. Another big sell-off on Wall Street today. At the lows a short time ago, the Dow was down 1,085 points. As you can see, we've come back. We're still down 650. At the highs for the day, we were down 272. The NASDAQ had been leading the way earlier. I believe it briefly turned positive, but it's down 1.5% right now. The Dow is down 2.5%. The S&P is down 2%. And the coronavirus outbreak is being felt both in these markets and across many different U.S. industries. In fact, we have team coverage on all angles of that today. Seema Modi is live at 3M, where production for face masks is rapidly ramping up. Eric Chemi has the financial impact on the sports world. Robert Frank with the fallout in the auto industry, and Diana Olick with a look at plunging mortgage rates. Seema, let's start with you and what 3M's trying to do here.
Well, Kelly, take a look here. You'll see the actual N95 respirator in real time being made from here. It's shipped out to a number of hospitals across the nation. This specific facility spans 450,000 square feet, with more than 650 employees are working around the clock to try to get as much product out to not just hospitals here in the U.S., but around the world.
We immediately ramped up production in this facility.
We have capacity to do that, and we've done that immediately. Really from more of a standard 5-day week to more of a 7-day week, with additional equipment as well that we've been able to bring in and turn on.
The key question is whether 3M and other face mask producers will be able to meet demand. The Department of Health and Human Services says the U.S. currently has 30 million N95 respirators in stockpiles, but it needs 300 million. I just spoke to Prestige, another manufacturer of N95 masks, and it says it received a combined order of 100 million from Taiwan, Singapore, and Hong Kong. So while these facilities are ramping up production and also operating at maximum capacity, the key question is whether they can fulfill these big orders. Kelly, back to you.
Seema, I have to say it's reassuring to see all of those N95 masks just coming off the assembly line behind you. It makes you think, all right, at least there's some new production out there, but are they anywhere close to being able to meet the demands, even just from the government right now?
Yeah, it's a rapidly evolving situation. They said they're in touch with Washington to try to see and meet the demand that's coming in from hospitals across the nation, especially as the risk of an outbreak here in the U.S. continues to rise. And of course, this is the N95 mask that is really in demand. It filters about 95% of particles. Back to you.
Yeah, feel free to bring a few back with you, Seema. We'd appreciate it.
I will.
Seema Modi at 3M for us. Now to the fallout for the sports world. Eric Chemi is here. And Eric, this, because of the stadiums and the crowds, is one of the main industries that people warn about.
That's right. So the coronavirus is making its impact felt across the world of sports. The top soccer series in Italy is playing many of its games without fans allowed in their stadiums. We've seen striking visuals of games happening with nobody there to watch. The University of Michigan's football team canceling its annual international trip because of virus fears. The Boston Red Sox kept a Taiwanese prospect from showing up at the team's spring training complex in Florida. Dozens of Americans playing in the Chinese Basketball Association, they're stuck in limbo because the Chinese basketball season has been suspended, and to make it completely canceled, players aren't getting paid, they're sitting around doing nothing, but they can't get released from their contracts to go look for jobs in America and in other countries. Formula One has already postponed the Chinese Grand Prix, and they're considering what to do with several other races in that region. The LPGA holding a Japan tournament without spectators. There's even been discussion about moving or canceling the Tokyo Olympics. Japan's prime minister called for all sports events to not be held for 2 weeks. That's a recommendation coming after a Tokyo baseball team said it would play games in an empty stadium. Olympic executives said they are still preparing for the Tokyo Games as planned, but they did not officially rule out alternatives. And of course, finally, the major American sports leagues telling CNBC they're monitoring the situation. They're in contact with the CDC, but for now, they're not suffering attendance declines.
Interestingly, even in the NBA, which has had ongoing games during this, you might have seen it there. Just real quickly, who do you think has the most to suffer financially from this if these empty stadiums continue? Because frankly, I'm sure as long as the games are still on TV, that's the biggest cash cow, right?
Yeah, I mean, there is a whole ecosystem for going to these events and the local businesses that are around there. Are you traveling to that event? Did you already buy the ticket? Is there some sort of travel insurance or trip insurance, ticket insurance? So there are a lot of different parties that start to come together here. I think the biggest impact would be the Olympics.
Sure.
If we saw something. In 1940, it was supposed to be in Tokyo, but then there was World War II. They never got those 1940 Olympics.
Oh, here we go again. Yeah. Hopefully it'll be fine by then. Eric, thanks. We appreciate it. It's not just the world of sports that's being impacted. Event organizers are also pulling the plug today on the biggest, or one of the biggest, annual auto events in Geneva. This after several automakers had pulled out on coronavirus concerns. And for more on the auto fallout, we turn to Robert Frank. Robert, what are you seeing out there?
Well, Kelly, that auto show, the Geneva Auto Show, it's the main showcase for luxury and sports cars, over 500,000 attendees. It was just canceled due to the Swiss government's ban on gatherings of more than 1,000 people. That comes as luxury car makers grapple with supply chain problems, you got the travel bans, and a slowdown in that critical China market. Now, I sat down yesterday with the CEO of Rolls-Royce. He said their business in China, that's their second biggest market after the U.S., has fallen, quote, close to zero, and that this shock may be different from those of the past.
We have seen overnight basically demand blipping, and then after the economy recovers, poof, it's back to normal. And these kind of patterns we also see currently with Corona, but nobody can tell you exactly how long that will take, and that's probably the difference.
Now, Rolls-Royce, they have a good long pipeline and a very lean factory in England with only about 2,000 workers. They're owned by BMW, so they can probably ride this out for the short term. But Aston Martin, they're in tougher shape. Their shares hitting a record low, down 65% from their IPO last year. They're pinning their hopes on a new SUV that was supposed to launch later this year. Big hopes there for China. The CEO saying this week, quote, "We hope and pray for a quick recovery in China." And Ferrari in Italy closing its museums, suspending its very popular factory tours, and restricting workers from nearby areas in the Lombardy region. That was the area most affected. So far, they have not shut down or restricted their production line, but the company said that could change overnight.
65% drop for Aston Martin here, and so much riding, obviously, on this SUV launch in China. So what do these companies do now? I mean, I guess as long as you said the ones like, if you're owned by BMW, not like Aston Martin, you have the cash, you have the resources to ride it out. What are some other options for everybody else?
It's the big unknown. The auto industry as a whole is looking for a decline this year of 2.5% based on what we've seen so far. The luxury end, especially the very high-end luxury end, could be much steeper than that. But as I spoke with the Rolls-Royce CEO yesterday, they just have no idea how long or deep this can go. So far, production is continuing, but it's just a big unknown as to how deep and how long it will go.
And investors in no mood for patience, I guess, to wait and see here.
Right.
Robert, thanks.
Thank
Robert
you.
Frank. How about mortgage rates now, which are hovering near historic lows? Could be a silver lining to this whole story, right? But the rates aren't even sliding as fast as you might think. Diana Olick joins us from Washington to explain. Diana?
Well, Kelly, get ready to refi. The average rate on the 30-year fixed hit 3.23% this morning. That's an 8-year low and very close to a record low, according to Mortgage News Daily. Now, the 30-year fixed loosely follows the yield on the 10-year Treasury, but it's not falling quite as fast right now. Why? Well, it has to do with risk to the investors in mortgage-backed bonds. Unlike Treasuries, which cannot be paid off early, you can refinance your loan, which pays the investor back early. And then the investor loses out on years of monthly interest payments. A super fast drop in rates like we're seeing now has caused a refi boom. And that has investors worried about more losses. So they're now paying less for your loan. And that means you either have to pay more up front or take a little bit higher interest rate. Now, given enough time and a little stability in the bond market, mortgage rates should close the gap with Treasuries. And of course, they're still falling, just not as much as you might expect. Kelly?
All right. Is that going to go all the way down, though, Julia? You got people here waiting in the wings looking for rates like, 3 and an 8.
I would go now. I wouldn't wait anymore.
Okay. All right. You heard it here. Diana, thank you very much. Diana Olick in Washington today. Let's get